धीरे धीरे धड़के आज होने को है आगाज, सफर पर चलने का बढ़ने का। इतना है हौसला, मिटना फासला, मंजिल ने मिल ही जाना है। ओ ख्वाबों से आगे जाना है, हम से तो
Very good morning. I am Priya Katoch from CII. I would like to extend my warm welcome to all of you for joining CII's ninth edition of Banking and Finance Summit 2022. We will be starting with the inaugural session in next 15 minutes. Thank you.
दिल धीरे धीरे धड़के आज होने को है आगाज सफर पर चलने का बढ़ने का इतना है हौसला मिटना फासला मंजिल ने मिल ही जाना है ओ ख्वाबों से हमसे तो उम्मीदें हैं, हमसे तो दिलासा है, हम पे है निगाहें भी, हम पे है भरोसा है, हम में है हीरो, हम में है हीरो, हम में है हीरो, हम में है हीरो। दिल से कहो ये हम में है हीरो, मिल के कहो ये हम में है हीरो, हम में है हीरो।
हर हिंदुस्तानी में एक हीरो है और आज इस देश की धड़कन का एक नया नाम है आपका हीरो होंडा। अब है हीरो मोटोकॉप।
Good morning, Mr. Munjal. This is Priya from CII. Am I audible?
Hi, Abhimanyu. Good to see you. Morning, Abhimanyu. How are you?
How are you? How are you? Sorry, I'm just figuring something out. Just give me a second. Sorry. Yeah.
It's like,
Hi, good morning, Abhimanyu. How are you?
Hi. Morning. Morning. Shah. Morning, Rajesh. Morning, everyone.
Morning, Mr. Srivastava. Prashant, I head the CII Northern Region based out of Chandigarh.
Wonderful, Prashant. I don't think we've interacted before, have we? May have.
Not really, not really. Yeah, I've just moved in a few months back.
Where were you earlier?
I was based out of Bangalore.
Interesting. Good. So I kind of do a few things with Northern Region, as you know. I'm sure you know
Look
that.
forward to your support. I'll come and connect with you.
Sure. Let's do that. Yeah. Great. How long you been with CII? Long years?
Yeah, around been with CII for around 17 odd years.
Okay. That's almost a generation. Interesting. You busy with agrotech now?
Kind of, we started a bit late this year. Initially, we were thinking whether we should do it, whether we should not do it with COVID and all. But we thought let's go ahead. So we started it in. I think we started the work sometime end of May, June, July. Things caught up. So we have Mr. Sanjeev Puri who has agreed to lead it. Of course, Tarun Sone has said that probably he'll also support. He's the co-chair now. He's leading the finance. He's leading the agri committee for the national thing. So yeah, so it's moving. It's shaping up well. Still pushing on. Yeah. I in fact hi.
Hello.
Morning, Mr. Vijesh.
Hi.
Vishesh, how are you?
Good morning. Hello, Rajesh. How are you doing?
I'm all right. Good to see you.
Good to see you too, sir. Good to see you too. I saw Abhimanyu briefly. I think, yeah, he's also there.
Hi, Vishesh.
Hello.
Sorry, I'm just trying to
Hi.
figure out some things. I am not used to WebEx, yeah.
Mr. Sanjeet Singh is there. Chairman PFRDA also there. So I think we should be able to start on time. Good.
You're in Delhi or you're in Dubai? Yep.
Yeah, hi, good morning. I don't know who to thank for this invitation. Is that Mr. Munjal? Do I need to thank you for this? My name is
Thank the
Sanjeet Singh.
CI Secretary and everyone here, Vishesh and
No, we'd like to
everyone here.
thank
But
you.
it's thank you for joining us. I think we thank
Pleasure
you for
always to
joining us.
interact. And so I recently joined at Niti Aayog. And so it's a pleasure meeting everybody. Thank you so much and good morning to everybody.
Thank you for joining us and being a part of this important summit.
Good morning, Mr. Bandyopadhyay.
Good morning, everybody. And thank you again for calling me.
Good morning. We interacted last year. Time flies. Been 1 year.
Yeah. Still remember. Thank you so much.
Vishesh, we
Very
can
good
start.
morning, all of you. On behalf of CII, it is my privilege to welcome you all at the inaugural session of CII's 9th edition of Banking and Finance Summit 2022. It's my privilege to welcome all the inaugural speakers, Mr. Vishesh C. Chandyok, Chairman, Regional Committee on Economic Development and Policy and CEO, Grant Thornton Bharat LLP. Mr. Rajesh Srivastava, Chairman, Rabo Equity Advisor. Mr. Abhimanyu Munjal, Conference Chair and Joint Managing Director and CEO, Hero FinCorp Limited. Mr. Sanjeet Singh, Senior Advisor, Niti Aayog, Mr. Supratim Bandyopadhyay, Chairperson, Pension Fund Regulatory and Development Authority. I would request Mr. Vishesh to start with his welcome remarks. Thank you.
Thank you very much, Dipti and the core team, for your support in putting this together. It's, again, my proud privilege to welcome all of you to this inaugural session of the 9th edition of the CII Banking and Finance Summit 2022. This is the 9th edition, 9th time we're doing this summit, ladies and gentlemen. We're obviously really honored to have with us Mr. Supratim Bandyopadhyay, Chairman, PFRDA, and Mr. Sanjeet Singh, Senior Advisor, Niti Aayog, as our guest of honor. Thank you, sirs, for taking time to be with us. From your, obviously, you have a very busy schedule. Of course, a very warm welcome to my friends Abhimanyu and Rajeshji, also here. We have a thing at GT, our culture concept that we say, we call it be here now. And that's basically about how you can try and disconnect from other things when you try and do one thing. And I would request you, particularly since we're doing this virtually, to consider, if you could, putting your cell phones at a distance from you so that whatever part you attend of this summit, you are able to be here now and take in whatever said. That will help your own experience of what you get out of being here this morning. Of course, with that request, let me just set the context and some opening comments. Of course, in recent years, India has witnessed a rapid progress in the financial services sector. The banking and financial services system has transformed itself rapidly to support the growing needs of the economy. Technology, innovation, and fintech are working in tandem and contributing to the dynamism of this sector. Some of feedback coming from somebody. Dipti, if you could kindly mute your line. Dipti. Thank you. So I just wanted to lay out some of the key trends that we are seeing at Run Thornton Bharat in this sector. The first, what we call digital at the core and experience at the fore. And that's really led by some statistics I'll just lay out in front of you. That entire transformation of the internet landscape, the digital landscape around us. Broadband internet users in July 2021 crossed 800 million, 80 crore. Jan Dhan accounts are now touching nearly 50 crore, 500 million. Aadhaar enrollments are at 134 crore, nearly the entire population, 134 crore. And 120 crore mobile connections, 1.2 billion. And therefore, new opportunities are opening up in implementing new and innovative ways of integrating and delivering financial services. This can be, of course, gauged from that statistic all of us are familiar with the 100+ unicorns in the country, half of which nearly were established last year. Right? And how these digital transformation initiatives can further the customer experience agenda. The customer experience agenda is something that I'm sure will be deliberated in the sessions that follow, or indeed this session. So that's the first, digital at the core and customer experience at the fore. The second is, of course, a huge focus on partnerships and alliances with the fintech ecosystem. The essence of successful partnerships is to enrich, of course, the core unique proposition of banking and financial services incumbents, but without losing the current leadership positions and customer ownership that they have. Whilst on the non-core areas, how to optimize wallet share through such partnerships. So that's the second trend we are seeing. A huge focus on partnerships and alliances with the fintech ecosystem. The third shift we are seeing is working in collaboration with the regulator. Reactive approaches of responding to regulator queries are a thing of the past, and the market participants are now collaborating with regulators to address key systemic risks. regulatory sandbox approaches by the RBI, IRDA, SEBI are an indication of the same. However, initiatives like digital lending, where greater collaboration is still needed between the regulator and the industry. I'm sure some conversation will also throw light on the same. How can industry collaborate better with the regulator on these new areas like digital lending? Fourth, as Mr. Uday Kotak told us at one of our partners meetings in August 2020, very quickly into the pandemic, geography is history. Geography is history, and hybrid models of working with a strong IT infrastructure have enabled global banks, global financial services companies to leverage that India talent. And I'm sure so are the Indian players leveraging the benefits that technology allows us, just like we are doing with this conference itself, right? Geography now is truly history. Fifth, we are seeing huge shifts in governance. 3 or 4 things. First, governance is no longer about internal audit, risk management, and compliance. We're actually seeing an audit of those functions itself. So quality assurance reviews, we're being called in to do an audit of the internal audit and its adequacy. We are seeing proactive forensic engagements. Companies are calling out, having led the forensic engagements for ILFS, PMC, Altico, Reliance, ADH. I mean, we were involved in pretty much every forensic in the sector. We're now seeing companies proactively take those steps to see what are the mines sitting within their system today that they need to address, versus only rely on big name boards, big name auditors, internal auditors, and other pillars, which are important. But there's an opportunity to go beyond all those things. Of course, huge investments in cybersecurity. I'll give you some statistics here. According to the IBM cost of data breach report in 2019, the average cost per breach in the financial services sector was nearly 50 crores. 50 crores was the average cost of every cyber breach in the country. So a couple of other data points. First, on the 2nd of August 2022, the government reported to the parliament, 2nd of August 2022, that in the last 4 years, 248 data breaches have occurred in Indian banks. 248 data breaches, 41 public sector, 205 private sector, and 2 foreign banks. Data point 2, according to a report by Trend Micro, in the first half of 2021 alone, ransomware attacks in the banking industry, first half of last year, ransomware attacks in the banking industry increased by 13x, 13 times, which is disproportionate to all other industries put together. And the New York Federal Reserve reported that financial firms experience cyber attacks 300 times more than others. Data point number 3, some Indian examples. Of course, we've heard about the Cosmos Cooperative Bank in 2019, where hackers siphoned off 94 crores from that bank. Several other examples like that with Canara Bank, the ATM, UIDI, Aadhaar software, so many others, and I don't want to name the entire list. So just to conclude, my comments, without a shadow of doubt, banks and other financial institutions in India have the capacity to rise to the challenge and continue to demonstrate their resilience by contributing to this immense progress that we are going to see, this unique progress that India is going to see compared to every other major economy. What we call shaping a more vibrant Bharat, a better India, not just a bigger India. A mission that we at Grant Thornton live by every day. And against this background, the Confederation of Indian Industry is organizing this 9th edition of the flagship CII Banking and Finance Summit 2022 with the theme Scaling New Heights, Stronger, Technology-Driven, and Resilient Financial Sector. Stronger, technology-driven, and resilient financial sector. And with these words, I'd like to welcome you all to this 9th edition of the CII Banking and Finance Summit. I'd like to now hand over to my friend, Mr. Rajesh Srivastava, for his comments, please. Rajesh.
Thank you, Vishesh, and good morning, Abhimanyu, and all the esteemed panelists today. I think it's, again, a privilege to be here today. And I'm also privileged that this is the 9th edition. I go back 9 years, Vishesh. Somewhere I was involved in the conceptualization of this. And I'm so happy that the baton is being passed on to Abhimanyu, who's certainly the generation next as compared to my white beard. So I think that's good news. Uh, moving on. So I think, as Vishesh you mentioned, that clearly we are in the throes of a major disruption, so-called in banking. What we're seeing and what we're going to see even more going forward is going to be complete radicalization, excuse me, of banking, as I would call. But let me first of all, again, go back to a little bit of some data points just for reference. I think loan growths, we are seeing that they are rising phenomenally. The last year in post-COVID especially, we're seeing them rise by about something like 14.5%, which is nearly tripled. And whereas the deposit growth of bank, that's not happening in the same ratio, that's about 9.5%. So obviously, clearly, loans are overtaking. The second data point here is that the growth essentially is coming from the retail loan segment, not so much from the corporate credit growth. And that has its own nuance because, while of course your mortgages, personal loans, auto loans, they could be rising because of a variety of reasons, but you need to have corporate credit growth as well for so-called productivity and contribution to GDP, all of that. That's going to demand a lot. Now, the other thing is that clearly CD, credit deposit ratio of banks, that's improved tremendously. There's something like 73% of CD ratio today as against much lower, and everybody was quipping about it earlier on. But with this, what you're seeing basically is that the banks are actually being forced now to raise money. That's important. So one, apart from the interbank market which they do or access Reserve Bank of India, the third thing is to go to the market. I think we all read just about, I think, Canara Bank or somebody raising 3,000 crores and issuing all kinds of securities instruments. And that's going to be a challenge as well, because at the end of the day, capacity to raise money outside has its own little trappings, right? So that we're going to see. Now, consolidation apart, what the banking industry has seen, I think fundraising and possibly, I'm just a philosophical view that there could be a case for a lot of international acquisitions happening actually in the Indian banking sector. I think it's overdue, frankly speaking. That's going to set in for a variety of reasons, which is going to happen. I think the other thing which is important and which is good news is that the gross NPAs have declined over the last year or so. The capital adequacy ratios has improved. Now, there could be many reasons for that. But I think one of the important things is that while
भैया
we
आप
can...
जब भी आएंगे ना तो मच्छर की दवाई डाल दीजिएगा, डेली मच्छर काटते हैं। हाँ नहीं, अभी तो मैं मीटिंग।
So somebody is...
Basically, if you could please, thank you.
Okay. So I think I said the capital adequacy and all, which has improved. The other thing which is important is that if you do a lot of intra-bank or interbank borrowings and all, then there's a contagion effect as well. So then if there's one bank suffers, the other bank suffers automatically. That's something which has to be watched out. Having said this, the post-COVID-19 or COVID-19 measures which the RBI took, especially in terms of the emergency credit line guarantee scheme, which was given to the banks. And the banks have been pretty much, lending or giving money to corporates against that ECLGS. The problem there is that the effect of that will come on actually a few years later. So the government will have to see. So that's a backstop guarantee given to bankers. One has to see how does it unfold. So the other one. Overall, I guess at this moment, I would imagine that everybody's happy in life, that the bankers look like in a much better shape than they were about 2 years ago, which is happy news. Coming to the disruption part of it, I think there is certainly, as we say, there's a digital invasion of the banking sector happening. Lots of things. I think the era has come for, as we call, unbundled banking, whether we talk about payment banks, we talk about neo banks, but it's basically one is talking about a single product, single vertical banking, which has come into play. And I think there are some good news also and some bad news also. The good news is that these neo banks or the single vertical bank, they don't need to go through all the banking regulation, the banking approvals and the licenses, so-called traditionally, which bankers have been asking for. They can do their business in a very, very defined vertical. I think if you look at how they're unfolding, uh, I think in India, a good part is that the time to market, or let's say market to maturity, is actually speaking quite low, surprisingly. I mean, we say about 2 to 3 years as against 5 to 6 years in Europe. So whatever you introduce in India happens quite fast, which is quite surprising. And that's a contrarian thing. If you look at the rural part of India, 60% population there, illiteracy, unawareness, all of that combined, and you see that how things mature. I mean, a clear example is that just about 5.5 years of demonetization in November of 16, and see what kind of a digital revolution has taken effect in India. Amazing. I mean, one can't imagine. I think per force it happened, but whatever. I think we've come alive on that. I guess our banking system is trying to adapt, and I will come to it in a minute. But once again, good news, and I go to State Bank of India, and they run what they call is YONO, SBI YONO, and which is the integrated digital lifestyle platform with something like 45 billion registered users. And I'm just paying compliments to the biggest bank of our country, some 26,000 branches and a huge amount of border balance sheet. And they are opening something like 29,000 new digital savings bank accounts per day via YONO. So look at the adaptation which has happened to an largest Indian bank. They are granting loans now, personal loans of something like 6,200 crores in the Q3 of FY22. And also amazingly, and I'm not surprised, the State Bank of India, I don't know how many of you know, they have the largest number of followers on Facebook and Twitters amongst all banks worldwide, not just here, of course, but worldwide. And that's a compliment. I'm sure there are multiple lessons to be learned by others. The other thing which is important is that if you look at the growing Indian young population, youngest country, and obviously different demands of all products, including banking products. So I think what is expected is that about 61% of Generation Z, X, and millennials will shift fully to digital banking, going in the next few years. Actually, they say about 10 years, but I'd be very surprised if it doesn't happen much quicker. So that's where we are. Clearly, the fintech revolution is playing its part here. As you said, Vishesh, there are lots of collaboration, partnership, which is now the trend, which has to happen. However, having said this, that will bring in its wake a lot of other factors as well, which we need to solve. One of them is clearly the data security and data privacy. And that is something which we need to attack, because when you have partnerships, then obviously standards differ. The so-called the eagle hawk eye differs from point A to point B. And if you don't solve it, as you know, in Western world, the data privacy and data protection, that takes absolutely a top space everywhere. And that is something which we need to guard against. It is like, outsourcing, which you have. So everybody has to comply with the same fair practice code, same governance standards, all of that. So that is something which has to come by. The one other part which is important for bankers is the risk management. Now, being a banker myself, I understand, and I've been decades into banking now, so I've seen the transition as well. I mean, the risk management systems itself, from what we had in early 80s to now, that's completely changed. Or if not changed, this has to be changed. Now, if you talk about digital banking, you're adding to the complexity of risk management. The risk earlier on was differently assessed. Now you got to bring in cybersecurity risk, data privacy risk. All of that also has to be brought in. Obviously, you have solutions in the play. You have talking about the AI and all of these innovative techniques, technology, which is somewhere there, and I think we need to bring in. One of the things which I want to emphasize is on the on the skill development side. I think, I was reading through somewhere that there was a PwC survey which said that the respondents from the banks itself, they said respondents say skills in their organization lag across a range of highly important areas, including cybersecurity and privacy. And I just mentioned about it. So I think apart from that as well, these adaptation to the new technology platforms, that has to be also 100% developed in the conventional banking which we have today. And if you ask my opinion, and all of us know, you will never have a model, at least not in the next 25 years, that you will completely replace conventional banking with digital banking. Grow slowly, yes. There'll be overlaps, there'll be connectivities, and someday possibly yes, but it's not going to happen in the anytime that soon per se. So you need to have a principle of coexistence between them. Even today, you have all the fintechs and all which you have. They're typically collaborating with the banking system just to take their business forward. So it's not that they're operating in a complete isolated module. That's also not going to happen. So we need to ensure that the banking setup also changes, is made aware, it's properly developed. And that's where I would imagine that I would call it the technology skill development that has to be focused upon. And I don't know the State Bank did what they did, but for certainly there is a case for all bankers to take it on. And what happens is that the banks need all these early warning systems which can come through all these new technology innovations, data analytics, AI, whatever we may call it. And that's got to come in, because when you start adapting to new techniques, new technology, these things are very, very important. So in short, and you mentioned about compliance culture also, Vishesh. Clearly, compliance also has changed, absolutely changed. And you're right that it's not about the internal audit per se, but audit of internal audit, that's a new classic example. But what I would also imagine, and that's where I draw a line, that compliances should never stagnate the business. That's also important. They should go hand in hand, they should facilitate. But the moment they become like, and I won't name, but some of the European banks actually they started complaining, even the US as well, saying that we are just working for compliance. The business growth is little, compliance is much more. And that's a very, very hazardous situation to be in. So I think we need to draw that line and be careful about it. We means that the regulators and the governments, there's nothing which I and you can do in that, but that's where we need to solve. So overall, I think just to wrap it up, I would imagine that there's a case that the banking most certainly is in the throes of a complete change in India as overseas. The good news is that adaptability that is much faster in India for all the reasons which are quite amusing reasons, enigmatic reasons rather, not amusing, and which we need to sort out. But all having said this, I think we will see a lot of changes. You mentioned about internet, this and that, and you all know about what's happening to the mobile banking. But clearly, controlling the risks, and that again, you mentioned that the number of cyber attacks and all which you're seeing on the banks, and that's going to increase actually because that's where the money is. That's where the money is. So you clearly see more and more of that, and we need to be ensuring that that part is well taken care of before we talk in terms of growth of digital banking. So which will happen irrespective. So thank you very much for the opportunity, and I enjoyed talking and look forward to the next and the next editions. Thank you.
Thank you very much, Rajeshi. Future generations will shift entirely to digital, but because our pace of adoption is quicker than elsewhere in the world, we will still see the conventional incumbents survive. You gave the YONO example from the State Bank of India, a great example of how something of that scale and that legacy has kept up with the shift. Abhimanyu, if I may bring you in now before we go to the chairman of PFRDA and Mr. Singh to get their views, I guess, Savannah.
Sure, thank you. Good morning, ladies and gentlemen. Mr. Supratim Bandyopadhyay, Chairman PFRDA, Mr. Sanjeet Singh, Senior Advisor, Niti Aayog, my colleagues and friends from CII, Vishesh and Mr. Rajesh, and participants. On my personal behalf, I would like to extend a warm welcome to all the dignitaries as well as the delegates at the 9th edition of the CII Banking and Finance Summit 2022. The 9th edition of the CII North Banking Finance Summit has been organized at a very opportune time with the pandemic behind us and India strongly marching on the path uh, and becoming the third largest economy by 2029, largely due to structural shifts since 2014, as per the State Bank of India's research EcoRap report. It is interesting to note that after overtaking the United Kingdom to become the fifth largest economy in the world, India is one of the fastest growing large economies. India's GDP growth in Q1 FY23 has been 13.5%. At this rate, India is likely to be the fastest growing economy in the current fiscal. S&P and Global Rating S&P Global Ratings has retained its 22-23 growth projections for India's economy at 7.3%, citing a smaller impact from the global slowdown on the domestically driven economy. The banking and financial sector has been making rapid strides and marching towards a formal setup. As per a report by State Bank of India in 21, which had estimated India's informal economy at 52% of GDP, which has now shrunk to between 15 to 20% of GDP in 2020 and 2021. As per RBI, Reserve Bank of India, credit growth in the banking system has also been at a multi-year high at 16.2% year on year for the fortnight ended September 9th, 2022. Last time credit growth touched 16% was in November 2013. In this current financial year, so far banks have extended over rupees 6.5 trillion in loans, showing a year-on-year growth of 5.5%. Over the same period last year, there was a decline of 0.3% year-on-year. Also, many of the reforms undertaken by the government like Jan Dhan Yojana, direct benefit transfer, taxation reforms, etc., has further expedited share of the formal sector in the economy. The success of PMJDY since August 2014 is reflected in terms of opening of over 46 crore bank accounts with deposit of rupees 1.74 lakh crores, with its expanded coverage to 67% rural or semi-urban areas, as well as 56% of women Jan Dhan account holders. The continuation of PMJDY beyond 2018 saw a marked shift in the approach to meet challenges and requirements of emerging FI landscape in the country. There also has been a shift in focus from every household to every adult, with added emphasis on usage of accounts by enhancing direct benefit transfer (DBT) flow through these accounts, promoting digital payments through the use of RuPay cards, etc. During the last 7 years, the use of Unified Payment Interface (UPI) across the country and digital transaction in India has increased manifold. As per RBI's monthly data, UPI transactions have increased from rupees 9.83 lakh crore in April this year to 10.73 lakh crore in August. Similarly, credit card spends through POS, point of sale, terminal has increased from rupees 29,988 crores in April this year to rupees 32,383 crores in August. The credit card spending on e-commerce platforms, which was valued at 51,375 crores in April, rose to 55,264 crores in August. The COVID-19 pandemic has provided a further opportunity to accelerate the process of digitization and adoption of digitization. Formalization has got a boost during this time through a greater proliferation of greater digital transactions. Over the last few years, the sector has had to withstand several disruptions. The BFSI sector has advanced drastically over the past year of how it operates. The digital ecosystem is banking kicked into another gear post the pandemic, a shift that is reflected in the growth of non-physical modes of transactions. In India, there has been a significant growth in big data revolution with integration of AI, ML, IoT into the financial services sector. Many Indian banks and fintech companies have opted for service-oriented approach through data analytics based on the intelligence gathered from digital footprints of customers to help in optimizing revenue potential and using it towards process automation, risk management, fraud prevention, resource utilization, customer retention, and acquisition. It is interesting to note that in the present scenario, the BFSI sector in India is sitting on a goldmine of opportunities. The government of India is actively pushing the digital transformation and the inclusion agenda. The country's young and digitally savvy population demands innovation and Uberization of services, and increasing penetration of smartphones and internet has brought on demand of hyper-personalized services to their fingertips. By leveraging technology-powered solutions, Indian banks can overcome most of the hurdles in the way to consolidate their leadership position. Many traditional banks are adopting powerful digital capabilities to launch value-driven platforms and business models. SBI's YONO, which was spoken about by the past speakers, DBS's DigiBank, and the IDFC First Bank has even the Post Bank that takes banking to every doorstep in the country are some interesting developments and examples of these. This trend is likely to continue and pick up pace over the next few years with more synergetic partnerships between banks, fintechs, and innovative new strategies for banks themselves. Implementing powerful middle layer solutions can help banks adopt digital models without disrupting core banking platforms. Concluding, I would like to say that business of banking is undergoing a significant transformation, and organizations that do not take this opportunity to revamp their business models will lose out on the future growth. It is not the question of merely adopting cloud models and greater scalability and agility. Right now, banks must focus on transforming their business and operational models to unlock new digital powered customer centric era of banking. Another important aspect of BSI sector is the non-bank financial companies, NBFCs. The NBFCs play a vital role in complementing the traditional banking service in the country. The sector has played a pivotal role in catering to a diverse financial need of the bank's excluded customers. Historically, NBFCs have been a vital cornerstone of India's financial ecosystem as an important financial intermediary channelizing savings and investments, especially for small scale and retail sector, as well as the underserved areas and underbanked sector of the Indian economy. As per the CRISIL report, that NBFCs might see a 11 to 12% growth in the assets under management by end of this fiscal, mainly due to a positive business outlook and the macroeconomic tailwinds. Over the years, NBFCs have evolved given the extensive changes in the regulatory framework of NBFCs in India, which have moved from simplified regulation to stringent and extensive regulation, as well as towards a rationalization according to the country's revised NBFC regulatory framework. Given these high levels of regulation, NBFCs have also emerged as a preferred option to meet credit needs since the low cost of operations have provided NBFC an edge over the banks. Additionally, NBFC sector has become an important mechanism to fuel growth. NBFCs have also become an integral part of all business services, including loans and credit facilities, retirement planning, money markets, underwriting, and merger activities. The sector also plays an important role in providing credit to the unorganized sector for small borrowers at local level. The rapid growth of NBFCs have gradually blurred the lines between banks and NBFC, considering that NBFC facilitate long-term investments and financing needs, which is challenging for the banking sector. Thank you and wish all of you the best for this summit. Thank you.
Thank you very much, Abhimanyu, and for laying that your perspective on shrinkage of the informal economy, on, of course, that digital transformation on the back of that Jan Dhan, Aadhaar Mobile, the Jam Trinity, the Prime Minister told us about, of the shift from the household to the adult, and, of course, at the end, about the role of the NBFCs in helping bring into the fore the traditionally unbanked. With that, before I come to you, Mr. Bandyopadhyay, I'd like to go to our first guest of honor, Mr. Sanjeet Singh, Senior Advisor, Niti Aayog. Mr. Singh, the floor is yours.
Thank you, Vishesh. Mr. Bandyopadhyay, Chairman, PFRDA, Mr. Munjal, Mr. Rajesh Srivastav, of course, Mr. Vishesh Chandyok, ladies and gentlemen. It is my pleasure to be here amongst such a distinguished gathering to share my thoughts at this 9th edition of the CII Banking and Finance Summit, which is organized around the theme Scaling New Heights, Stronger, Technology-Driven and Resilient Financial Sector. The impact of COVID-19 pandemic and the recent geopolitical crisis and the resulting disruptions and its ripple effects have been felt across the globe far and wide. We have witnessed supply chain disruptions leading to a shortage of commodities fueled by post-pandemic pent-up demand, geopolitical tensions which have led to segregation of the world into blocks which are essentially focused on supporting their own aligned interests. Now, these economic disruptions are reflected in the vulnerable triangle of stagnation, inflation, and external imbalances, which are experienced by all economies, big and small, to varying degrees. India has not remained untouched by these global disruptions, but we have proven ourselves an exemplary in inflation growth management. Our advance towards enhancing ease of governance, boosting infrastructure investment, large-scale digitization, and pushing for inclusive growth has continued undiminished. The greater thrust on Atmanirbharta in manufacturing, improvement in logistics, and closely monitoring of supply barriers as well as success have led to successfully withstanding our external shocks and have kept India well on track for an ideal economic growth, as has been shared by the distinguished speakers before me. Now, this is witnessed in improved high frequency indicators, increased private consumptions, better financials of corporates, improved revenue collections, as well as improved social indicators. Now, this positive trend has found reflection in most of the multilateral projections of India's growth story. So when we at NITI engage with a multilateral, whether it be the Moody's, whether it be the various banks, EDB, IMF, We are happy to share with them the growth story and the resilience of the Indian economy, which is extremely well received. I can share with you. The edifice of this spectacular growth and the resilient growth, like all modern economies, is built on the bedrock of a sound, resilient, and efficiently functioning financial sector. We have witnessed a distinctive shift in the business of banking from traditional branch banking to digital banking. Technological innovations across economies have challenged the traditional financial intermediation processes. This paradigm shift has been ushered in by innovations in information technology, growth in mobile internet connectivity, market-based financial intermediation, and of course, the advent of fintech. Government, on its part, has announced a series of schemes and deployed impressive fiscal resources for creation of digital infrastructure to realize our aim of digital India. Improvements in technology have enhanced the cause of financial inclusion and tech-enabled public goods delivery. Direct benefit transfer, or DBT, through the digital mode, as has been shared by my previous distinguished speakers, is among the best examples. DBT is among the best examples of tech-enabled public goods delivery. Financial inclusion drive pioneered by the JAM Trinity is today followed by 317 schemes across 53 ministries through the direct benefit transfer to the beneficiaries and have enabled large-scale migration of people from tech deprivation to tech adaptability. This has enabled large-scale formalization of the economy in a much shorter span. On the other side, India, with the highest fintech adoption rate, which is globally at about 87%, is set to emerge as a global fintech superpower. With nearly 6 billion transactions a month, valued over 10 lakh crore rupees, India's unified payments interface has become the best performing real-time ecosystem in the world. And in fact, as has been shared by my speakers before me, so the UPI, along with Aadhaar-enabled payment services, have emerged as the backbone of our retail payment system. With greater technological penetration and adoption of tech-enabled devices, digital economy in India is projected to be around $800 billion by 2030. The Governor RBI, in a recent address, has spoken about technology as a disruptor, which throws up both opportunities and challenges. The growing economy and the young demography of India demands greater capital infusion with better bundling of financial products and robust financial services. Banking and financial sector is increasingly being called upon to come up with innovative ideas and deploy ultra-modern and sophisticated technologies, employing greater use of predictive and analytic systems such as big data, artificial intelligence, machine learning, and blockchain technologies to bring in greater efficiencies and to deliver a better customer experience, as was highlighted very correctly in the beginning of our session by Ashish. In all these digital initiatives, we also need to factor in those sets of customers who may not yet be digital savvy, or those who may want to engage physically with the bank. It is therefore crucial that while driving various tech-enabled initiatives, the continuity of existing systems and processes is maintained, and they do not see frequent disruptions and non-availability. With increasing use of technology and digital services, the incidence of digital frauds and customer dissatisfaction are also on the rise. I will not touch upon the cyber threats, which my colleagues have already spoken on. So speaking on digital frauds and customer dissatisfaction, this calls for ensuring robust security controls, reliable and efficient delivery of services, transparency of terms and conditions to customers, which often becomes a very very basic cause for grievance among the customer base, and by investing in building necessary awareness among the customers. It is all the more imperative that these aspects are factored in when financial institutions introduce or enhance technology-driven products and services. The financial services sector will continue to witness this trend of technology-driven changes well into the future. Those offering financial services and products will have to strive hard to remain relevant in the ever changing economic environment and would need to continuously improve the quality of their governance. They will be called upon to network their business strategies and business models and design customer focused products and services by leveraging technology. Possibilities are immense only if we are ready to embrace them while meeting the challenges which come along with them. With these kind of words and context, I would like to thank CII for providing the opportunity to share my thoughts with a good number of who's who of several eminent financial institutions. And lastly, given the basic ethos of Niti Aayog, the National Institution for Transforming India, I am looking forward to the discussions in this edition, and of course, those which will follow, with brave and imaginative and transformational ideas and suggestions emerging which could enable India to take its rightful place as a leader in the new global order. Thank you so much.
Wow, thank you very much, Mr. Singh, for those lovely words. Like Abhimanyu, you also talked about the formalization of the economy, direct benefit transfers, the entire UPI data, etc., and of course fintechs powering the way. But you also touched on, despite the infection, despite the invasion, the resilience in our economy to continue to stay committed to the growth that Abhimanyu also touched on. And you called the banking and financial services sector the bedrock of that growth and the future. So thank you very much for those words. And with that, to our guest of honor, the Chairman PFRDA, sir, last but not the least, Mr. Bandyopadhyay, your kind comments, please.
Thank you, Mr. Chandok, and good morning to everybody. Mr. Abhimanyu Munjal, Mr. Rajesh Srivastav, Mr. Sanjeet Singh from Niti Aayog, and all the senior office bearers of CII, ladies and gentlemen. It's a great opportunity for me to talk about pension sector, which is rarely talked about, and about retirement benefits that we provide, which is an essential need at this point of time. And why so, I'll try to explain to you, and giving us this platform. And I also thank CII for joining hands with us, not now, maybe 2.5 years back, and very actively in organizing mostly online sessions where we can talk to the industry heads, or maybe the HR and the finance heads of the different industry bodies associated with you, and discuss them about the different benefits of NPS. See, actually, the journey of PFRD started way back in 2004, and it came out of, I believe it was a strategic decision, strategic change that the government had undertaken at that point of time to shift from the old pension scheme, which was an unfunded defined benefit scheme, which had become unsustainable, financially unviable by that time, to a defined contribution scheme. It was not an easy decision, but government not only had taken that decision and implemented it from 1st of January 2004. Though initially it started with central government employees, then it went to state government, then we opened up to corporate bodies and individuals sometime in 2009. And as of today, when I'm talking to you, I'm very happy to say that we have more than 57 million customers with us. And last year itself, we added more than 10 million customers. And year after year, the number is growing. And the asset base that we are managing today is a little over 8 trillion rupees. Now, looking at the pension sector, or the sectors which provide some kind of a retirement benefit in India today, of course, the first and foremost, which started possibly the earliest with the enactment of Employees Provident Fund and Miscellaneous Act way back in 1952. If we take the entire EPFO corpus, it's about 14 lakh crore. Of course, it includes the pension part also, the EPS. And along with that, there are certain kind of special PFs. These are available. And these are mostly in the mandatory sector that is there today. Apart from that, there are approved superannuation funds managed mostly by insurance sector. If you look at the voluntary segment, in voluntary segment, of course, we have the public provident fund, then different insurance plans, as we call them, individual annuities, either immediate annuity or deferred annuity. And then we have mutual funds, which are taken voluntarily. Under mutual funds also, there are retirement schemes. And obviously our NPS, and along with NPS, later on another product was added, which again is a unique of its kind, and the guarantee is given by Government of India. And I believe world over, you will not see the pension scheme of that kind, where the contribution is also defined and the benefit is also defined. That is known as APY, which was launched, Atal Pension Yojana, which was launched way back in 2015. Now, talking about pension or retirements as such, why is so much of concern today? If you look at the demography, in 1950s or 1950 to be precise, the data available that shows the life expectancy at birth was just 35 years. A child which is born is expected on an average to live up to 35 years. Where it has gone today, after 7 decades, it has gone up to 70. It is just doubled. And with every passing year, we know the reasons also, advancement in medical sciences and all that, that is going to increase and increase only. So with this, what is happening, and if we take mostly 60 at the age of retirement or age at which the working life ends, then there is a long journey, and I believe it is a very meaningful journey ahead, even after 60 years. And what we see today, unless these things are planned early, people always have the fear of actually spending their entire corpus well before uh, they come to the end of life. So what do we do at that point of time? That's why our effort has been throughout to reach out to people and to ensure that more and more people join and join at an early age. If we talk about corporates, for the number's sake, yes, we have more than 12,000 corporates today who have registered. It's not that all of them are contributing for their employees, but mostly they are in voluntary nature. Where they are doing today is essentially, it's a very good service that they are giving to their employees, is providing a platform through which it's deducted from the salary, the contribution, whatever the employee wants is deducted from the salary, and on a monthly basis, it comes to the NPS system. It's very smooth, it is very effective, and it is yielding some results. But out of 12,000 registered corporates, if you look at it, we have just about 1.6 million employees who have opted for NPS, which shows the take-up ratio is very, very poor. Though we have infiltrated into a lot of corporates, but ultimately how many people are taking up NPS, that is a big question. Yes, our distribution channels are mostly there. Banks and fintech companies, they are doing their bit. But I believe the corporate leaders also, they have to come ahead, and they also have to engage with their employees at an early age. And basically, maybe when they are joining their services, to see that they are also encouraged to save for the future. The question of pension and planning for retirement always is postponed. And they feel that since I have 35, 30 years before me, why not postpone it? And we have seen in many such seminars, the questions are coming that the serious conversation on pension starts only when it is mid 40s or late 40s or early 50s. So hardly there are 10 to 15 years left for planning. And obviously they cannot have a corpus. Even during Corona pandemic, all of us have seen people got treatment in the hospital, they came back safe and sound, but their lifelong saving is gone. Very unfortunate, but very true. So what to do about it? So as I said, let us start early, choose wisely, and NPS is such a scheme where we provide lot of flexibility. You choose your fund manager, you choose your scheme. If you are not happy with the fund manager, you can change them twice a year. If you are not happy with the scheme or the asset allocation that you have decided, you can change it 4 times a year, free of cost. And more than that, if you are really confused which asset allocation to take, there are default schemes which allows you to grow your asset base according to your need and according to your risk taking ability. We know that risk taking ability of every person is not same. So accordingly, there is a plan is sort of which you can tailor to your needs. So this kind of flexibility is not there, possibly in any other scheme. We say it is cost effective, but unless I give some figures, people will not believe today how much cost effective it is. If somebody comes through a distribution channel, and as I said, our distribution channels are mostly banks, all kinds of banks, and then there are fintech companies. There are now other kinds of banks like the payment banks, small finance banks. They are also helping us quite a lot. So all these are trying to see that customers are onboarded. Now, talking about banks and all that, I just need to mention a point which Mr. Srivastav talked about in his initial speech about the popularity of SBI and its YONO app. I'm very happy to state that at our request last year, 1st of October, actually SBI launched pension NPS through their YONO app. And immediately we saw the traction. Almost close to 180,000 people joined NPS through SBI, and we are expecting a far better result this year. So these of technical innovations also have added a lot many customers. Going back to the cost part of it, if somebody is contributing just about 50,000 rupees a year for 35 years, then the cost is just about yearly cost. Uh, you can take it as total expense ratio, but we call it equivalent annual fees. It is just about 8.5 basis point. So every 100 rupee you give in a year, I take just 8.5 paise out of it. Balance is already invested into your corpus. And if you come through all these online channels, we run a ENPS channel here. Through that channel, it will be just about 6 paise a year. You all know how much it costs for all other financial products. We talked to International Organization for Pension Supervisors, a body of which we are also an executive member. They say, see, your cost structure is so low, it is an outlier, and we don't take that into consideration because that will actually give a different kind of result altogether. So that gives an indication, possibly it is the lowest cost pension product today available in the world. So all these benefits are there. All our distribution channels, they are providing the online support. Today, large number of our customers are joining through online channels. And I'm very happy to say that since the pandemic period 2021, not for a single month we have seen a degrowth as compared to the pre-pandemic period. Actually, the second year of pandemic 21-22, it was a 60% growth over the previous year. And the initial year, it was almost a growth of 15 to 20% over the pre-pandemic. So this has continued, and thanks to the support and platforms provided by CII and other industry bodies, FICCI, Indian Chamber of Commerce, PSD Chamber of Commerce, and everybody. And thankfully, our returns also have been quite resilient over this period. We have seen the volatilities over a period of 14 years. We have a track record of 14 years of investment. Our equity funds have given a compounded annual growth rate of about 12.5%. Our corporate bonds, despite credit events and the volatility we have seen in the corporate bonds market, it has given a return of about 9.4% over this 14 year. And the safest one, the government securities, which does not have a credit risk at all, only maybe interest risk involved, that also has given close to 9%. It is safe, flexible, cost efficient, and being a pension scheme also, it gives some kind of early access of withdrawal if you need. Of course, these are limited, and it is triple E. At every stage of contribution, accumulation, and withdrawal, it is tax-free. No other pension scheme allows 60% access on retirement tax-free. Even 40%, which is compulsorily annuitized, that also when it goes, it does not take that 1.8% of GST, which as an individual, otherwise you have to pay to buy that product. So with all these benefits built in, I believe slowly people also will realize we are trying to create this awareness, public awareness, that you come, join early, and enjoy a dignified life even after retirement. So thank you all for giving me this platform and giving our some ideas about the pension, how it is doing. And I believe these efforts will create more and more awareness about pension and retirement and why it is so important today. Thank you so much.
Thank you very much, Mr. Bandyopadhyay. Thank you, Abhimanyu. You need to log off. Please go ahead. But what a wonderful summary of the evolution of the pension system. And there's, making that pitch to us. I think there's a role for CII here to help you increase that proportion of corporate awareness and involvement. We all talk about the skilling challenge, to make good our demographic dividend. But on the other side, with this life expectancy growing, which is a good thing, we will also have, a retirement challenge, as you just outlined, which perhaps, Prashant, there is a role for CII to play and up our game. I see, the panelists for the next session have already joined. My friend Sachindra, I can see, and others. So I'm not going to take time to summarize. I think I did that after every speaker, but hopefully we've laid the context for further deliberations on some of these themes at this 9th edition of the CII Banking and Finance Summit. Rajeshji, thank you very much for starting this summit back in the day. Mr. Singh, thank you very much for your time. I know Abhimanyu is already logged off. And Mr. Bandyopadhyay, once again, thank you for joining us. Back to you, CII.
Thank you so much. My sincere thanks to all the dignitaries who have joined today and sharing their valuable insights with the participants. Now may I have the pleasure to introduce our moderator for panel discussion 1, Mr. Ram Ganesh Iyer. The panel discussion is on the role of digital transformation in banks and NBFCs, creating new age financial institution to meet dynamically changing customer expectations. Now, I would like to introduce the panelist of the panel discussion, Mr. Sampath Kumar, CGM, SBI, Mr. Sachindra Nath, Vice Chairman and Managing Director, Ugro Capital, Mr. Prashant Kumar, CEO, Standard Chartered Capital Limited, Mr. Jyoti Prakash Gadia, Managing Director, Resurgent India, Mr. Rajiv Ahuja, Executive Director, RBL Bank, Mr. Satyam Kumar, CEO and co-founder, LoanTap. Over to Mr. Ram Ganesh Iyer.
Hi, I hope I'm audible.
Yes, sir, you're audible.
Thank you. Good afternoon, everyone. It's indeed a pleasure to have this panel on a very important topic. I think we have the benefit of having senior executives across banking, NBFCs, and those focused both on the retail side and on the SME or corporate side. So I think we can get a good 360-degree perspective. So I just wanted to outline kind of the 2 or 3 points we'll take up in this discussion, and then we can go around the room. I think one is the starting with the customer first. The digital transformation is not an end in itself, but is a way to get to a better customer experience and a better customer service delivery. So how do we think about the customer episodes and the experience of the customer in these episodes, whether it is applying for a loan, pre-closure of a loan, and various other financial services. So we'll talk a little bit about that. The second is kind of how do you enable this to changing the customer journey or modifying the customer journey, enabled by 2 sets of interventions, one on the technology side and the other on the operating model itself. And we hear about agile a lot in the context of operating model these days, so we can talk about that. And finally, how do you drive change on the ground? How do you get people to kind of think differently from the way they are used to over the years, and drive that change through the system? So it'd be good to kind of talk about it in these 3 blocks. So maybe if it's okay, I'll go around the room. Mr. Sampath Kumar, from a banking perspective, how do you think about this topic and the changing customer expectations in today's time?
Thank you, Sir Ram Ganesh. Thank you, distinguished panelists. It's a great pleasure to be around with such distinguished panelists. The change had been very drastic. I remember the days when I put a standalone ATM in an industrial area where young village boys used to cycle 2 kilometers to come and see the standalone ATM, that there is a machine which is giving cash. From that day onwards, the standalone ATMs, the standalone systems in the branch, then it was what you call local area network, where different floors were connected. Then from the local area, we moved to WAN, then we moved to core banking. Yes, it has given a lot of ease of business. I mean, I can draw money from anywhere, I can transact from any place. The brick and mortar doesn't matter to me. But one flip side of that is that we have lost some sort of personal touch. If I have a grievance, if I send a mail, if the other institution doesn't respond, or if the mail gets on, moved from here and there in a musical chair, I'm left with very little options. Maybe I go through a call center, I go through some VoIP and all. I may or may not get my issue resolved. This is one area where definitely there is a change which is required. Well, technology has become everything. It has redefined banking. It has made millions of income tax refunds, direct benefit transfers, getting into accounts in no time. I need not worry about it. It just comes to my account and I access it. Gone are the days when MSMEs deposit a check, wait for 15 days, 20 days to get it cleared, where my cash credit account is having a very high interest. And we are able to take a credit to the hinterland thanks to digital movement pushed by the government with other initiatives. It has changed lives, but there are certain points which briefly I will touch. The digital for a common man or end guy, an MSME, has a cost. That cost is still prohibitive. So we may have to brainstorm or work around for a better, for a lower cost or a sharing cost like that. Cloud and other things have come big way, but we have a long way to go. Definitely, it has transformed the system. It has transformed life for common man. It has transformed life for MSMEs. But it's a journey, and we keep on changing. We keep on innovating, and we have miles to go. And there, our scalability, our scaling up in a very structured way becomes very important. Yeah, I stop here.
Got it. Thank you, Mr. Sampath Kumar. Mr. Ahuja, again, continuing on the banking side, but more from a private bank perspective, just wanted to get your views on, how you see the customer expectations and landscape evolving in a way that demands a digital transformation.
Yeah. So thank you so much, and thank you for having us as part of this panel. I think I'll echo the comments made by Mr. Sampath Kumar. I think the customer now has choices, and he or she may want them at their doorstep or in the branch or on a technology or an assisted technology platform. And I think as banks, we need to take the complexity internally, because you can't, more often than not, you can't instruct the customer now that you do it the way we are set up to do. Now, I'm not saying it all happens overnight, but somewhere I think the simplicity of what the customer wants, where she wants it, in the manner she wants it, has to be assumed, and you got to progress towards that. And therefore, the complexity has to be absorbed internally, which means your second question, Hamganesh, is the technology and the operating model. So to me, I have to be progressively ready and also ensure that the customer's desire is not to repeat himself or herself every time they interact with us. Therefore, the use of the demographics and data which I have, or which I pull from the external data sources, is kept very, very efficient and almost straight through. And the customer also is very clear that I have many more choices progressively, and I think that's happening in across all markets. And therefore, the economics of delivering this service, which is the cost to the customer, and the way you organize your factors of production becomes extremely important. So to me, actually, the digitally minded customer, whether they take it at a kirana store or through the app or through a branch or through a partner ecosystem, basically their expectation is faster, cheaper, better, or do it for me, and sometimes it's DIY, sometimes do it for me. So we have to absorb that business model complexity, and I can tell you that, and I'm sure we have all manners of organization structures represented in this panel, that the complexity is what challenges institutions, and agility or lack thereof is really when you have to combine many of these things to an existing operating model, which has worked for decades, becomes the big point. And I think this is only going to become more and more manifest. So we have to just live with this duality of a vastly changing consumer or a SME and internal operating model, with legacy as well as a new model which needs to be incorporated.
Right. Thank you. Maybe I'll go to the other end of the spectrum. Mr. Satyam Kumar, you have, you disburse loans, and historically, NBFCs and fintechs have differentiated from the banks by their, faster turnaround times, more responsiveness and so on. So how do you see kind of the digital playing a role with your customer set as you compete in this market?
Thank you very much, Mr. Iyer and CII platform for inviting us for this discussion, and fellow panelists. And coming, as we are spending more and more time in the first part of the discussion around the UX, I think the expectation of the customer around the UX
has transformed because of their experiences where the digital transformation has happened much earlier in the economy, whether there was a platform business of on the payment side, or whether that was a platform business on e-commerce sites. And also those transformations has really created a customer set who has a very different expectation. And as a banking, a few years back on the other side of the table, and a few years now that I'm on the fintech side of the table, what we have seen is that there is a very difficult task to hold on between the compliance, user experience, and a risk management tool. So what we see is immense amount of possibilities, which is what excites us, and that's why you see so many of us jumping out and building or started the fintech on different modes. Someone on a payment-led transformation, someone on a lending-led transformation, or someone on a wealth-led transformation. The possibilities are super exciting when it comes to creating a user experience, and that's what really excites us. When we look at the data set itself, then from a traditional banking data set point of view, we see each of the data is available today in a consented environment. The problem is that those data which can create a good user journey, they are into multiple blocks. Some of the data are on the GST block, some of the data are on AA block, some of those data are on a UPI block or a payment network block, some of the data are on a POS block, some of the data are on ITR. So so there is like 100+ API integration that we have to run to make one loan possible. Okay, and if any of those network fails temporarily or goes down temporarily, also the user experiences goes for a toss. So while there is a huge amount of obsessions about the user experiences, the current set of challenges or the infrastructures that we are seeing, it's still lacking in terms of giving that level of UX that you want, whether it's around the KYC, whether it's around the e-contracting, or setting up the collection modes or repayment modes around NACH or any of those stuffs. So it has been a very challenging task for all of us. But what we see is that probably we have moved the needle from a 3-day lending or a 5-day lending to next business day lending or the same day lending. And on a certain set of the transactions, you are still able to create on the go kind of an experience where you could imagine a customer moving into a mall. By the time he selects a product, okay, in those 15 to 20 minutes, you will be able to create a fully underwritten, fully compliant product, okay, without which sits at par with any of the credit underwriting horizon that you want to build. So we are seeing these challenges there. We are still seeing a challenge around the infrastructure for creating that required UI, and we have to deal with these multiple blocks of data, money, somewhere we co-lend, multiple blocks of data of the user itself, and use cases also, because many times you fund for a particular use case and you do not fund for another use case for a certain kind of a loan. So these blocks, integrating each of it together is a complex task. And we are seeing infrastructure challenges, and one of the major challenges that we have been seeing, which banking sector has also been asking RBI, is the compulsion of the banking sector to hold the entire system on premise, because on the cloud collaboration becomes easy. The moment you go on premise, you have to replicate the entire environment in every banking partners network. So I think the amount of hurdles that we are crossing is unimaginable, but we are committed to deliver a better and better UX every other day.
Got it. Very interesting to hear kind of the diverse perspectives on the customer expectations and the implications on digital. So what I'll do, if it's okay with everyone, is we can change gears to talk about kind of the tech building blocks or the tech enablers to deliver this kind of a digital thing. So maybe Mr. Shachindra Nath, I'll kind of turn it over to you to, in your opinion, you have a vast experience in financial services, across the whole spectrum. What are the tech building blocks, or how does the tech stack kind of look like so that it can deliver, the customer expectations that we just heard that are evolving now?
Yeah, thanks, Mr. Iyer, and thanks CII for inviting me on that. Look, we only do one segment of the market, which is MSME, and we are more focused on M part of the MSME. All our customers are between turnover range of 10 lakh rupees to 5 crore rupees. Now, our belief is that the entire MSME credit is under a very serious transformation. It is transformation to the extent today, if you walk into a Chroma store and you want to buy a fridge or a TV, you can buy that in roughly half an hour by availing credit, which is on tap available to you. But an MSME which has an order of 10 lakh rupees, wanting a 7 lakh rupees of credit for against that order, it can take anything between 15 days to 3 months as well, in which time he has to actually fulfill his order. So one of the biggest, as a lenders, unless we don't have the complexities of the bank, because we only give money and recover money on a predefined dates. So the simple and single customer expectation from us is to say no quickly, not yes, say no quickly, right? Because one of the biggest frustrating point for customers of when they approach lenders, either digitally, physically, through intermediation by any channel, the decision doesn't come. So if you tell him that no, I'm not willing to give you the loan, he can actually go to somewhere else. But the problem is that it takes around 15 days or 20 days or 30 days to even say yes, whether we will be able to do it or not. And I think so that's where the data, and we differentiate between data and tech. So the differentiation being the data for decisioning is becoming super powerful. In last 4 years, we invested very heavily. Our view was that the traditional problem of not being able to say yes and no to an MSME customer was, being able to assess his intent, eligibility, and ability to pay. And with the advent of GST, digitization of banking, and maturity of the bureau, right? We have roughly around now 10 million plus bureau score for MSME customer. If you combine the three, these three things get tested automatically, and that's the problem we have attacked. Wherein in first 30 minutes, once a customer walks in through any of our channel, we can say no or yes, right? Today, still we say 75% of our customer we say no, 25% we say yes. But the ability of using the data and eliminating all the traditional method of assessment is transformative. And I think so you will see at least 5, 7 large financial institutions which are in lending being able to take the MSME financing near to consumer financing, where the biggest customer experience of being able to say receive yes and no quickly would start happening. That's the first part of it. Second, the tech piece of it. The tech is, so we say data is for decisioning and tech is for simplification and process improvement. Tech doesn't have any mind of its own. It is only what you do physically, can you do it through technology, right? So you can go to a customer and do his KYC by collecting 100 of pages of document, or you can do it quickly through multiple modes. And that's a journey. I think so with every passing day, there is massive amount of regulatory push behind making it life simpler. And also there is huge amount of market ecosystem which has got created. I agree with Satyam that, sometimes something get dropped, one API doesn't function, but you have to look at from the perspective where we were 5 years, 7 years back. Today, when the account aggregation in India would become really mature, actually it's an open banking system. So every bank's entire customer bank data is available to every credit lender. Right? See, think of the power of that and what you can do from there, right? Which means that, one of the reasons why banking used to mature, because you used to look at a CASA account and what you can do with the customer. Now, more or less similar power is available to everyone. So technological transformation and the tech stack, which we call India Stack 2.0, the combination of the OKIN, the ONDC, and multiple framework which we are emerging, and I always look at it in the time frame of 5 to 10 years, you would see the MSME financing in India becoming very, very transformative, and it would improve the customer experience. I must say though that it is little odd that customer themselves are not adopting themselves digitally when it comes to the financial services or the banking services. All of our customers use UPI for making the smallest payment, even to a chaiwala and panwala today. But when it comes to provide the same information to a financial institution, it becomes a problematic. during period of COVID, we went to complete video KYC. 70% of our customer failed to do video KYC because their Aadhaar was not linked, and we couldn't to their mobile number, and we couldn't do a video KYC for that. So there is also a need to give confidence to the vast majority of the customer set, especially business customers, MSME customer. First is that sharing data to a financial institution through a digital mode is safe and confidential. Second, it actually improves the confidence of the lender onto you. And third, be digitally available, right? You cannot be digitally unavailable and think of improving your customer experience by being in physical mode. So it's a journey which both the financial institution and more so the customer have to take. I will stop here.
Thank you, Mr. Nath. It's a fascinating perspective. Mr. Prashant Kumar, given your past experience in the so-called semi-urban rural markets and now I think both on the asset side and the liability side, it'd be great if you could give us a bit of a bird's eye view on the role of technology both on asset side and liability side in facilitating lending. And I think we have heard the other panelists talk about the practical problems in terms of getting data in one place. But it'd be great to hear your perspectives on this.
Thank you for inviting me, and happy Navratri to all of you. My own sense is a little different. You have to look from 1999 to the current scenarios. Phase 1 up to 2005, 2006 was all about automation. So all banks, all financial institutions, everybody was automating their own processes internally, whichever best way they can get with their. The second phase started when we were talking about pure silos integration. So end-to-end journey, pure silos. So if you have a personal loan product, silos. If you have a lab product, silos. If you have a bill product, silos. If you have a vehicle lending product, silos. And you are talking about end-to-end. Now we are getting into an era where we are talking not about silos product, but we are saying that there is a common KYC. It has to be cutting across all products. There's a process and the data integration has to flow in, and it has to dealt with all kinds of products and all kinds of What does that signify? That would change your target operating model. Target operating model would change how you acquire customers, how you kind of look at your own internal systems and processes. If you bring in customer centric, then whether your team compositions are in line with that or not. You need a large tech team, small tech team. You need a product governance team, not governance team. Each of these has a much larger impact around that. What is our regulators asking us? So I'm an NBFC. What is our regulatory expectation that a customer should walk into any branch and he should have one view of all his products, loans, which is there, and same on the liability side as well. In case you are into raising liability pure from customer, then his ability to see through his liabilities, interest charge, statements, whatever he wants, it's available. That would mean that you're going to integrate huge amount of systems, both on asset sides and liability side, talking to each other, giving him one access, one view. Now, like one of the panelists rightly mentioned, out of 91 apps, he was talking about integrating. I'm trying to build a stack around wealth lending and personal loan and lab. I have to integrate 153 apps, APIs. That's the level of integration which apart from that, while integration is one piece, then you have to also make sure that the governance standards are met, data securities are met. So there's not kind of breach around that. So lot of these things is going to change. Coming to your part around semi-rural and urban market, I think we are seeing huge amount of traction around that. With the smartphones penetrating and the point of sale changing. I'll put it this way. Earlier, the point of sale was onto the premises, bank branches, or a DSA, or what you call DMA, or any referral partner point. Now it is in his phone. So how do you make sure that your point of sale is happening on his phone for, like Sachindra said, on MSME or a consumer loan or whatever kind of loan, and he has to do it there itself. It's a DIY journey for him. So he has to log in, he has to do some activities, A, B, C, D, E, and then he says that done. I'm done. I should get my loan. I should get my loan. That would mean that your ability to make sure that it doesn't drop off from a journey, your ability to make sure that the experience is there, number of clicks are less, the interfaces are built in so quickly. It's a huge amount of investment, huge amount of understanding and into that. So practically you have to make sure that you have a large data team or a large team of people who are working on those kinds of data and making sure that it's available to them. That's the way the landscape is going to change in a big way. 5 years down the line, I think all of us are going to talk banking in a very different, or lending in a very different perspective from what we are doing it as of now.
Right. Thank you, Mr. Prashant Kumar. Mr. Gadia, on the topic, would love to get your thoughts on two perspectives. I think one, you have been an industry practitioner yourself especially in SME lending, and you also wear the hat of CII now. So from both these perspectives, how do you see this space evolving, and what role can CII kind of play in kind of, because the problems faced by a lot of the participants are common, and probably there is a systemic fix that can help everyone. So would love to hear your thoughts on that.
Good afternoon, yes, sir, and good afternoon to all the panelists. Since apart from CII, I also have two firms. One is Resurgent India Limited, where we act as an intermediary between all the MSME fund seekers and all the banks and NBFCs. Apart from that, I also own a fintech company called ScoreMe.in, where wherever we have developed all the lending type of a softwares, and approximately around 200 banks and NBFCs are using that software. Based on these two experiences I just want to highlight 4-5 important trends that I could see what is emerging out of it. First trend that I could clearly see is that customization has become the key. No averaging is not required. Earlier, you could see that now the insurance policies or the insurance pricing that you could see, now it has been definitely been done as per the age, as per the criteria. There are so many hundreds of criteria coming in. An insurance policy taken by everybody in this room may have a different pricing in terms of the premium that we need to pay. Same thing need to be evolved in terms of the banking transactions also. Banking transactions till now, it is more or less on the credit score, it is more or less on the rating, but how can we evolve to much more granular level? That's where I think so it is far more important in terms of that customization of that loan rate of interest, costing, pricing, everything. And it has to be done faster in terms of whatever that customization has to be done on a faster premises. This is the trend number one, what I could see, which is coming in. Trend number two, what I could also see is that the KYC, although we'll talk about that know your customer. So know your customer, traditional banks has been all using about कि आपने आधार दिया नहीं दिया, आपने आधार income tax return. It is the KYC is much more beyond whether I am married or not, what is my monthly income, where I go for shopping, what is everything. So know your customer has evolved from the document or from that API or from that Aadhaar link or from my income tax return, from my driving licenses to creating my personality type. So this is where the KYC has moved in. So this is a definite shift in terms of what the shift which is happening there. Trend number three, what I could also see is that fintech is given, the automation is given. How much manual is the question now? That is going to be a differentiation factor going forward right now. Maybe up to 2 crore of rupees we can decide कि so much of manual intervention हम सिर्फ उसके एक बार visit करेंगे और we should do a call once. Maybe from 2 to 5 crore of loan amount we will do this much amount of manual thing. From 5 to 10 it will be 100% manual or 100% feeding of data, whatever is there. So 100% of fintech is given now. How much manual it is going to be the differentiation factor between all the fintechs and the banks and between all these NBFCs coming and working together that way. Fourth trend, what I could see here is the challenge that I could see everything coming. It is in the long-term financing. Long-term financing means black swan events are going to be the call of the day. And how this long-term financing, like road project or any of the long-term, we want a 10-year loan, we want a 12-year loan. Raw material prices are fluctuating around 70% of money between up and down within a year, where 85% of my cost of production is my raw material prices. And given that so much of fluctuation, so much of volatility in my commodity prices, with so much of uncertainty also in my external environment, how are we going to appraise the long-term loan? We are only talking about the fintech banking. It is all about retail. It is beyond that also. It is that we have to think from a long-term perspective, long-term loan evaluation, how it will be done, how the documentation need to be evolved, so that whenever there is a black swan events, whenever there is some sort of external events happening, the loan installment, the documentation itself will take care of the EMIs and everything. It gets itself got adjusted that way. So how can we take care of that? Last two trends, just wanted to just pass on by. The last but not the least should be one of the trend is that who is the business owner? Business owner is basically the customer owner. You talk about fintech, you talk about NBFCs, money will be a commodity. Whoever owns the customer owns the business. So that's ultimately going to be the talk of the day. Lastly, sir, 31st March data is a passe, sir. We have to be getting into a dynamic type of a pricing. We can't work on a 31st March balance sheet, which is a single day number. Past 365 days and coming 365 days, sir, 700 and all this 30 days can't be decided on one day. So that's where I think so the trend is definitely going forward for IR. So this is what I would like to rest till now.
Thank you. Very interesting set of organized set of points and something to ponder over for every one of us. I'll again switch gears in the interest of time, and Mr. Sampath Kumar, moving to you. How do we think about the different operating model to kind of serve this in this change environment? And let me elaborate what I mean. Historically, banks have had, a separate credit team. There is a separate operations team. There is a feet on street, and so on. But now that you have data from, alternate sources coming in, the customer needs have changed. How does that get fed back to, how credit sees a particular file? Does credit change how it kind of approves a loan, how it collects, and so on? So how does the change kind of manifest in across the different departments that have historically, functioned in a certain way?
Yeah, very interesting question indeed. Now, from processing a credit file with reams and reams of papers and balance sheet, we are now moving towards a digital mode. We have pre-approved personal loans or pre-approved business loans, where we look at the transaction history of the customer, we look at his CIBIL score, and things like that. We extract data, we scrub it, and we find XYZ is creditworthy, I can give money. So we have moved in a very big way on this. We are scaling this particular area up with the aggregator coming in place. Aggregators coming in place. This is going to burst out of streams. So even for MSMEs, we are rolled out pre-approved business loans for our customers who have a good track record, and I check their GST returns and ITR, and we have set up new business rules. We are totally redefining our risk system. Sir was talking about past balance sheet. Now we are moving away from that. How is the cash flow? Whether he's going to have the cash to pay his bills, how his cash is going to pan out in the next 12 months. So that is a big transformation on this side, and it is looking at more centralized, more data based. Take any industry. Now I have data on how this industry is behaving. What is the leverage in auto? What is the leverage in EPC contractor? What is the leverage in real estate? What's the growth percentage in tech? What is the growth percentage in this particular service? I have granular data which I can leverage. Only thing I should ensure is that it should not be garbage in. And we have moved a long way in that. We are ensuring that the data which is getting in is filtered, and it is going through a digital system. There is a real digital footprint. So somebody cannot say that, the file was lying with me only for 2 days. Now we have a digital footprint, so I need to respond quickly. So there is a real shift, particularly for the MSMEs. I can quote one particular example, the trade receivable discounting, which is happening on 3 platforms, RXIL, MN Exchange, and A-Trades. The volume is going very high. It is helping supply chain. Based on the industry major, the small MSME is able to get wonderful rates, and banks are competing and they're bidding for the small invoices also. So it has created real transformation. It's a transparent thing. There are no rubber invoices. The invoices are real, and there had been a movement of goods. So it had created, safety, security, speed, cost effectiveness. That is the transformation which is happening. But at the same time, the digital ecosystem on lending cannot focus only on lending. Lending is very easy. I can cut a check whenever I desire, whenever money is flush, whenever my chest is filled with a lot of cash, I can cut the check. But who is going to do the recovery? So in this area, digital efforts have to be a little on a higher scale, or we need to do a lot of brainstorming and build up digital infrastructure for the recovery part. For the collection mechanism has improved a lot. You have system-based collection, you have RTGS, NFT, ECS, UPI, a lot of it. But unless in many of the accounts, many of the customer relationship, unless I go and visit him and see what is the problem he is having, whether his order book is low, whether his collections are not coming up in time, whether he has a labor problem, whether he is not concentrating on his business. That input I don't get unless I go and have a chat with him. I go and sip a cup of tea with him. This definitely cannot be replaced by digital. So a clear blend of digital as well as physical engagement with the customer. And there also, what I find is that tech is only an enabler. One-to-one physical engagement makes things a lot easier. Perhaps if you need to visit 12 times a day to one particular client, 12 times in a year to a particular client, maybe 8 can be on digital mode. At least 4 of them should be on a physical mode. He opens up, he tells his problems, he discusses expansion. So you can decide where you can fit in. You can give his advices, you can give your advices, or you can share a comparative study of another industry. So a combination of digital and physical and more enablement, more than sending an SMS or sending a mail and making a call center on gently reminding him of the installments. Something more than that, and an improvement in the ecosystem, improvement in the legal framework by way of digital. Now we are moving to digital documentation. We are moving in a very big way on that. So all these things will have to go together. And apart from the financial system, the external ecosystem also had to be nudged to come along with us. With this, I think in the next 5 to 7 years, we can see a big transformation in the credit ecosystem, particularly for MSMEs.
Got it. Thank you, Mr. Sampath Kumar. Mr. Ahuja, I wanted to ask a question more on the softer side. I referred to change management and kind of doing things differently initially. I guess, beyond all these frameworks, I think the hardest thing, we have observed on the ground is getting people to change kind of how they operate. So wanted to get your thoughts on, how you drive change on the ground. Is it by, doing some controlled pilots, demonstrating success and then scaling it up, or do you have some other mechanisms that have worked for you?
Yeah, so that's a very important question, and actually the complexity as I was here talking about what an organization like a bank or an NBFC has to go through actually makes the softer aspect of change management adoption equally critical. And I'm not talking about the customers here. I think what we've tried doing is that we run small projects in special teams so that it does not interfere with the day-to-day, because the day-to-day is also important. It's not like everything is changing overnight. And as they scale up, we start getting people involved from other groups so that they all understand what it is. I mean, so demonstration effect is very important. And some of these projects are run personally by me, let's say, okay? So that there is some sort of a umbrella for any potential failure or hiccup along the way. And then we rapidly add few more projects based on the learning and then scale them up. And if the project does not work, we don't go and be too much self-critical. We just move on and redeploy the talent. And now what that does is obviously it's a little I would say rugged and also it's a flux. It's nothing like very neatly described, because I think if you describe it too neatly, then you lose the serendipity of the entire process. So that has helped us embed some of these practices way down to. So when we do analytics, if you talk analytics to somebody who's a data scientist, he or she gets it. But if you talk analytics to a branch manager, the guy will say, what does it mean for me? So you have to translate that into the problem statement for the branch manager. So that needs an in-person discussion, maybe building dashboards, eventually explaining to them, and then eventually they should be able to use these dashboards themselves, or ask for them themselves. So it's a thing where you pick up few things which becomes lighthouse kind of projects which demonstrate the success, and the success has to be demonstrated in hard, in terms of P&L or scale, eventually, and then you rapidly roll that out across the organization to the extent you'd like to. Obviously, the larger challenge is that some of these things need, within the organization, many business segments to collaborate and cooperate a lot more, which the larger you become, the tougher it becomes, because we all are being driven by KRAs, and also that also needs some level of bringing people together. But we found that actually over the last 5-6 years, I've been attempting to do this. Today, at least in the organization, the digital mindset is reasonably well established. We may not have 100% success for it, but now whenever you pick up a new thing, we already have a group of people who know how to attack it and how to navigate the organization internally to improve the chances of success.
Right. Mr. Ahuja, you mentioned analytics as an example, and that actually brought me to the kind of next subtopic I wanted to cover, which is in this whole digital transformation, how do we look at kind of the power of data and analytics? So maybe Mr. Satyam Kumar, I'll turn to you again, given your kind of focus on as a fintech on kind of being nimble and using data. How do you use data and analytics along the whole customer life cycle?
Hey, thanks, Ram. Very important for us to address it because, as we discussed that, we talked of a banking transformation from a point of view of handling automation, handling silos, and trying to integrate the operating models or a different product, use cases. Now, what we are seeing in last 5 to 6 years is that the way the data has been structured in the industry or the way it is available, it was never in that fashion. And now we might say that machine doesn't have a mind of itself, but machine can follow a given process in much better way than any of us. So like a banker, we always keep on analyzing a risk from a particular segment arising out of a particular segment or from the other segment. That we do on a quarterly, monthly, or in a fixed pattern basis. The risk is arising every other day. Okay, so the risk doesn't wait for a CEO or a CRO to come, put a trigger in the system, and then everyone will assemble and discuss that, hey, this risk has come because of an Ukraine, or this risk has come because of a particular activity happening in some pocket of India. The risk is happening while we are speaking day in, day out. Okay, so the way we are looking at a risk itself has changed, and it's more logic and a data driven. So in the beginning, we might call it as a machine learning and all, but now 4 years back when we were discussing the use of AI, and everyone, including people in Singapore and all, were questioning that, hey, AI has not worked. Today, 4 years down the line, we are now one of the staunchest supporter of a traditional cash flow based lending. We say that, hey, AI works. Okay. Now, where does the AI work? So first I'll address that, and then we'll say that how we are using it as a model. Right? So half of the time of a banker goes in saying that, hey, which are the customers, you look at all the customer and then you pick up 10 or 15% of those customers in doing processing. So you are always processing 80 or 90% of the customers on the wrong end of this thing, which doesn't fit into your decile. Now, the risk that you are running on a good customer being lost out because of an AI is an opportunity loss. This opportunity loss is much, much lower than the process cost and the tat that a good customer has to endure, because you spent most of your time and the talent in processing the other side of the customers on the stick. So we all start our journey differently. Loan Tap started its journey from point of view of saying no, where all we can use an AI to say no, and then we started looking at it where all we can accept the AI based on the historical results of the last 4 or 5 years, which has seen an event like COVID, which many of us have not seen in our life. I mean, if my biggest seniors in the industry say that they haven't seen an event like this, then I can also say that most of us would not have seen that kind of an event. So having gone through the COVID test and all, that the way the data is stacking up, it will be able to withhold different situations. So now, where all these kind of informations are working. So as we are looking at, we first look at a customer, and then we look at what are the parallels to solving this problem. So one of the parallels of looking at a customer is, as I continue going back to a mall example, in a mall you have a brand and you also have a popcorn. Okay, so the moment a customer moves in, the mall identifies that which segment the customer has to move, and accordingly things are laid out in that pattern. So your elevators are designed in that pattern. So because getting a customer to the mall is the most difficult part. The moment you have got it, you want to hook him with one thing or another thing. So the first thing which starts is a decile based scoring, depending upon what product you are catering, and you define that, hey, this decile I never cater to, or I don't intend to cater to, so that you keep your both the customer unhappy, so the customer doesn't go unhappy because of higher rejection rates and all, and you keep on very high on the NPS score. I mean, your net promoter scores, which is what you have to deal with when you are dealing in a digital environment. So use the decile on a selection process, and then starts building the risk based on a different data sets. So the recency of the data set that we handle is that you are having a transaction data from the mobile network, you are having a transaction data from the bank statement network, and you are also having a transaction data from the supply network if you are dealing with an MSME ecosystems and all. So now the data. So when we were building a credit risk engine about 10 years back, we used to say that if somebody is spending more and more in bar and all the places, probably it's a riskier customer. So you should try to be a bit careful about this kind of a lending. Today, that has become a past. Now, what you have to look at is that how much of the money a customer is spending on the gaming sites of his monthly income. Okay. Isn't that a speculative? It is speculative, whether we want to design it as a skill game or whatever. If you are underwriting a salaried guy or a business guy on an individual income, and if a substantial part of the inflow is gaming on a speculative spendings, then how do you treat this set of customers? What is the frequency? What is the frequency of a seeking loan? So each of these has become a lot more data driven now. So if we look at what Mr. Sampath was alluding to, using the data or using the AI in how do you manage the portfolio. Portfolio management is about engagement. How do you engage the customer? So first, it's a basic engagement layer which you create. Based on that engagement and the input, you have to create an active way of managing a portfolio on how the customer's health, financial health, has shifted every month. Thankfully, the data with some lag and all is available from a multiple system. So I can see a customer's whether his bureau has deteriorated 3 months down the line, or the bureau has remained whether the total outstanding on his loan or total credit in his account has moved up or it has moved down, for me to allow more loans to the same customer, or for me to proactively go and sit with him now and say that, hey sir, you have borrowed more and more. Now how do we structure? Is there a way we can structure? Can we move some of the unsecured loans to a secured bucket and all? So you create a customer onboarding journey. Then you select a customer for best suit kind of a product. You use a risk engine to score the risk, which is beyond the bureau level risk and beyond a cash flow based risk mechanism, which moves in more financial behavior as well as stability behavior of the customers, like the nature of residences, anything and everything you can build. Each of it gives you a some degree of a correlation, and cumulatively it gives you a correlation which works for you. And then you use it in the portfolio management itself. So once you lend to the customer, a traditional banking, when I'm doing, that was all about looking at a negative event. If the EMI has not bounced, everything is hunky-dory, don't go and meet the customer. Now, and the moment the EMI bounces, that is the worst time to meet the customer. because you are on the worst patch of the lender and the borrower relationship. Okay. So here, the moment you change the engagement to an active engagement where you are sensing that, hey sir, are you, it's looking like it will slip, or it's looking like you have a more space now to, you know, to convert some of the loans into a longer duration or a shorter duration or whatever. So this engagement is very different than the way we imagine an engagement, and each of these engagements are based on two. One is the data led, and the second, it is about creating multiple communication channels, starting from a WhatsApp to an app to whatever you can bring to the same table. So it's a more a relationship approach, but that relationship totally digital driven and not RM driven. And that is where we differ from the largest private sector banks in India, where, you know, the best of the banking is about the relationship, but we say that that same relationship will be carried out in a digital environment, in a closed loop app environment, or in a closed loop multiple, I mean, depending on the customer comfort multiple platform environment. So this is where we see it using being an engagement. Second, data. The third, the risk, and the fourth is the relationship management towards a portfolio management approach. So this is how we see it holistically as far as the ecosystem is concerned.
Thank you. That was quite a fascinating insight. Mr. Nath, just a similar question to you. Mr. Satyam Kumar gave, a retail kind of a customer perspective. From an SME perspective, any key differences in terms of the use cases of data and analytics that you see?
Yeah, I think so. I alluded that in my first slide itself. As I said, that you should divide the MSME customer in India in two parts: unserved customer and underserved customer. So unserved customer, which is normally new to credit customer, and underserved customer, which has some kind of credit history. He can have a small loan, or the entrepreneur can have a credit card loan where he will have a bureau footprint. We focus only on the underserved market, not the unserved market. Our belief is that the use of data in decisioning is best in underserved market. It is very difficult for unserved market, because how can you use the data for somebody who doesn't have any data, right? But for the underserved market, which itself is very large, and actually the impact which you create on that is very significant. So if I'm a small business, in existence for 7 years, and I've been running a small manufacturing unit, and we are very focused on 8 sector and 100 subsector, and I need an incremental 50 lakh rupees of loan. A 50 lakh rupees loan for a running business for 5-7 years, multiplies the productivity and effectiveness of business vis-a-vis somebody who's just starting, right? So, but within the framework of this underserved market, actually, as I said, that the decisioning now can be completely automated. Now, and that is, I think of this way. I know 10 years back or 6-7 years back, you go to SME customer and say, Bhaiya, I want to give you a loan. And what is your revenue? So he says, sir, all my revenue is in Kacha. Please come and sit in my shop, look at all my challans, and you can tally how much of business, material is going out of my system. Then you say, okay, that is fine, I will be able to do that. But why your balance sheet or the PNL is showing so much of stress? There is hardly any margin of profitability. He would respond saying, India may, margin in my business is 10 to 15%, tax rate is 35%. If I happen to save 50% of the tax rate, my margin goes up by 25%. So that's why the real income in my balance sheet is not there. Now it is you as a lender job to figure out what my actual profit margin is. So once finally lender, by sheer frustration, he said, if you don't have a clear top line, if you don't have a clear bottom line, give your property and lend you against that. So there is no choice for lenders. But that has now changing. First and foremost, a large portion, the way that GST framework has got built, large portion of MSME by force are getting trapped into that. The cost of being away from that network is very prohibitively expensive. So this artificial margin which MSME used to generate is now getting curtailed, and that's why they are in the formal system. Third, at least 30 to 40% of MSME have realized that being part of a formal ecosystem increases their credit capacity, and which means they increases their volume of business. So now their same 10% margin on is not on a lower base, is on a higher base. So all of these changes which is happening, and then a lender's ability to assess the what GST is just not the turnover data, right? We get 400 plus parameter on that. The counterparty, the teracity, the repeatness, the how much of that turnover is reflected in the banking. So if you combine these two, right? So you combine the turnover data, you combine the banking cash flow, and you take the bureau behavior, not the bureau score, the behavior. What is bureau behavior? So you may have a 650 or 750 score, CMR 3 score, but you may not be very good on credit, because if you have not taken any large loan and a small loan, you have been just paying on time, your bureau score would be very good. But you that loan, there you may be applying 10 more loans every month, and that may be an input to take. So around 1400 plus parameters on bureaus can be analyzed, and once you put that in a box, you can give decision very, very quickly. So that is what is happening right now. We are looking at more parameters of evaluating, using data. And as Jyoti said, that especially for SME, what happened on 31st March 2022 is no longer relevant, because the cash flows for MSME are volatile. Every month or every last 3 months is a very different than what has happened 1 year, especially post demon, post pandemic. So we have been using we are now starting to go beyond, this framework of what we call our data tripod. We just recently did an experimentation of correlation between electricity consumption and turnover to figure out GST related, fraud. So in the states wherein you can pull electricity bill through an API, you correlate the consumption of electricity for a manufacturing unit with the increase into the turnover. And if the unit has not used any alternative method of energy, there is something wrong. So more and more sets of formal data can be integrated for your credit decisioning and also for your future portfolio management. So our EWS system now have ability to predict the future default of a customer 15 months out, and that is more behavioral, right? So if and a simple method to do that, you're taking a secured loan or an unsecured loan from a one lender, and constantly you have been applying for more secured loans, which means that you are taking more secured loan to prepay your existing loan, right? So there is something going on, and which means that customer need to be advised, not coerced, be advised that this is not good for you. Please manage your cash flow within the size of the business. So I think this is where we are right now, and it's an exciting journey.
Right. I'll, in the interest of time, I'll move to my last question. And, that was around kind of stepping back. We looked at specific aspects of the whole digital transformation. But stepping back in terms of if I were, in this space as a financial service provider, and I was looking at kind of the overall aspiration and ambition of my digital transformation, let's say for the next 3 years, what parameters, KPIs, for data points should I think about? So maybe Mr. Prashant Kumar, just get your thoughts on what are the 2-3 things I should set as a digital ambition for myself as an FS player looking at digital.
So look, the digital transformation would mean the way our target operating model internally is going to change. This is how I look at whether you want a large sales team, small sales team, large credit team, small credit team, large product team, large tech team. What would that mean? There are sources of data which is going to come in either through an assisted way, or you're going to procure, or you're going to ride on some partnership and alliances model where the data is going to come in, sit inside your system, and you're going to decide on that. That would mean that the nature and structure of your team for acquisition of own customer would change. And it cuts across various product categories. For unsecured loan, like Sachinder said, it's much more easier, and individual it is sachet finance is much more different view around how you kind of look at originating and growing your base. For a secured journeys wherein it breaks if you have to create a mortgage, because obviously the mortgage piece comes in and changes the journey into that. So that would kind of change the way you are looking at acquiring your customers. So what KPIs would need digitally set is that one is that whether your risk frameworks are aligned to deal with the digital problems or not. Here, and Why I say that? Because it's about non-face-to-face meeting customer versus face-to-face meeting customer. In a non-face-to-face environment, what all risk parameters you're going to look at, what are the risk enablers you're going to do that, and how effectively portfolio monitoring. And our panelist from SBI said that the recovery becomes a very daunting and critical task around it. If the loan falls beyond a certain percentage, your cost of recovery is going to go far ahead than what you're going to recover. And that is kind of makes it very difficult proposition, sending up notices and into that. So that would change the way you are going to look at your year. Second is that partnership and alliances. The future is not going to be the way you're going to acquire customers. It's largely going to be based on partnership and alliances. Certain activity ABC you are going to do, and certain DEF somebody else is going to do. And both of you are going to work together and make sure that the loan is disbursed or it's being underwritten correctly. Acquisitions and that. The third piece is around, like one of the panelists was mentioning, is about who owns the customer and how much you are going to look at it to the customer. And the last piece is that, what I call is a platform-based lending versus balance sheet-based lendings. People like us, NBFCs, banks are all balance sheet-based lending. So we lend according to our own balance sheet strength, according to our own risk appetite and capabilities. But there are alternate source of lending which is coming on. A food aggregator may find out a different way of lending. A cab aggregator may find out a differentiated way of lending. And other platforms like Amazon, e-commerce may find out a differentiated way of lending, which I may not kind of be doing into that. Now, whether I'm going to be there, and looking at those customers, and whether my risk profiles, my acquisitions, my models, everything is going to be done in that. The last piece of KPIs, everybody needs to have a tech training or tech ability to understand tech as a part of your system, right from the base of this. One of the things which we in banks pride is that even if you ask our peon, he knows what credit risk is all about. So the culture around which which a bank systems are generally work around is that you ask anybody and then he knows that there is a credit risk angle around into that. Now, going forward, how do you marry that tech and the credit risk and your ability to raise in your culture? So whether you are able to be nimble enough to make sure that new technologies adoption are going to coming in quickly or not, whether your team is geared up or not, they are trained, equipped, they understand what is going to happen in the future. So lot of these are going to change, into that, and that you have to rewrite into their into their scorecards, into their KPI, into their training modules. So that's my take on that.
Thank you, Mr. Prashant Kumar. Mr. Jyoti Gadia, last question for you. Similar question. I mean, how do organizations think about setting for themselves a digital ambition, let's say for the next 3 years? What are the 2-3 parameters, in your opinion, we should focus on?
Yeah, just to highlight some of the point that the earlier speaker has told, like Sir Satyam and Nath sir has also told about that they are talking about 15-month EWS and other thing. What is my experience that has gone that we are reading into data too much. And earlier, in case if the account would falter, maybe we give him some sort of a chance. Matlab, if there is a check bouncing happening, by the time the Sampath sir and his team could reach the office of the other guy, तब तक 6 महीने का time हो जाता था. And by that 6 months of time, the client could have recovered and the check bouncing could have happened. Now, sir, वो सोच भी लेता है कि sir, if the check bouncing might happen, so there is a team of people reaching there. मतलब there is a यूएस के अंदर में गैप बोल के एक कंपनी ने बैंक्रप्सी फाइल किया एंड वॉट एवर वॉज द सप्लायर इन इंडिया दे हैड ए हॉरिड टाइम इन द कंट्री दैट द यूएस गैप माने यूएस के अंदर में एक गवर्नमेंट कंपनी or that company which has filed a bankruptcy in the US, and whichever was the company which was remotely connected with that, and all the private sector banks were first to react to it. Look, sir, our software is saying, our system is saying, we want to get out of your company. So you imagine that in case if something happening, if something sneezes there and your software starts predicting कि sir US के अंदर recession है and everybody dealing with the US companies, and you start coming and telling कि sir I want to get out of this system now. That is what they only understand that way. So it means the downfall which used to take, or the company used to take, now it is 10x more faster also. It is not only that we are only getting into a faster downfall, माने we are getting into कि लोन मिलने में आसानी है सर, लोन खराब होती है तो हमको और खराब करने में भी सर the speed has also increased too much there that way. So I think so how we can take care of the downfall thing, what is there, that how can we much more looking into the aspect that we don't get into कि company के साथ में don't get into a panic mode and start getting that way. That's where I think so some sort of a balance, some sort of thing that need to be rectified and done that way. Regarding 2-3 issues that you have pointed out, ki, sir, there are approximately around 150 APIs that you need to link in. There are some sort of, what sort of data that you need to work it out, what sort of correlation, sir. Sir, it is where the business case would be. It is where the differentiation would be, sir. Iron ore is sold at 5. Suppose if it is sold at X rupees, and special steel is sold at 50X rupees. So X to 50X is whatever कि कितना आपने आयरन, कितना आपने हीट प्रोसेस दिया है, क्या क्या केमिकल उसमें ऐड किया है. So this is where the data layer, this is where the fintech layer, money would be a commodity, sir. And you have money at 6%, 7%, and if you want to earn set 30% out of that, or whatever the difference is, that this is where your data churning ability, this is where how you interpolate the data at some point of the time, like how the GST returns can be linked to a gas bill, how the GST return can be, or how this some sort of data correlation relation, and how sort of authenticity of that data, sir. Haryana data would be different, Haryana GST gas bill would be different, or GST data would be different. How we can get into much more granular data in terms of pin code wise, in code of everything, sir. In my opinion, there is two distinct change which is going to happen is this, ki, sir, now banks and NBFCs, they have got only two income. One is fund-based income, another is the non-fund-based income. How are we going to make income from the data? How we are not going to make income from the money right now. We are only going to make, like State Bank of India might be having 5 lakh customers जिसको ये पता है कि सर फ्लिपकार्ट से कितने लोग सामान खरीदते हैं सर. They might go to another brand and say कि सर I can shift the entire customer to you provided you give me this. So how can we start making money out of the data? We cannot make money out of the money now, sir. Money would be a commodity going forward, sir. So this is where I think so the change would be going forward. Ki, sir, fund-based and non-fund-based income would be a passe, sir. Thank you, sir.
Got it. Thank you. Things were just heating up, but I think we are out of time. So I think we spoke about a bunch of very interesting insights. Starting from the customer expectations, where hyper customization is probably expected and necessary. We spoke about things like decile-based scoring, which can kind of help with that. Then on the enablers, we talked about the technology, and I think we had some very good points in terms of how it needs to be a phygital kind of an engagement, and we need to decide the vectors by which we decide how much is digital versus how much is kind of physical. Then on the we had a good discussion, I think, on the softer aspects, cultural aspects of how pilots and so on can be used to demonstrate success and test and learn in this. And finally, I think we spoke a lot about risk and analytics, whether it is used for underwriting, whether it's used for early warning signs of distress. And I think finally we spoke about the risks of being too digital without being cognizant of the real world kind of issues here in India. I think all excellent pointers, and hopefully this will enable us to kind of have a solid program for digital transformation. So thanks a ton to the entire panelist set for sharing these insights with us, and thanks a ton for your time.
Thanks, Ram. Thanks.
Thanks, everybody. Thanks, everybody.
Thank you.
दिल धीरे धीरे धड़के आज होने को है आगाज, सफर पर चलने का बढ़ने का इतना है हौसला मिटना फासला मंजिल ने मिल ही जाना है ओ ख्वाबों से आगे जाना है हम से तो से तो दिलासा है हम पे है निगाहें भी हम पे भरोसा है हम में है हीरो हम में है हीरो हम में है हीरो हम में
हिंदुस्तानी में एक हीरो है और आज इस देश की धड़कन का एक नया नाम है आपका हीरो होंडा। अब है हीरो मोटोकॉप।
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will perform, I will outrank, I will achieve, I will fly high. I am the I in SBI. I am the I in SBI.
I'm backed by the nation's trusted bank.
I am the I in SBI.
SBI, the banker to every Indian.
Hi, good afternoon, everyone. I warmly welcome all the panelists and the delegates to the second panel discussion of the day, which is FinTech Era, Driving Culture, Strategy and Innovation. I would like to invite the moderator for this session, Mr. Vinay Narkar. He's partner KPMG India, to please take forward from here with the session. Thank you.
Thank you, Deepti, and thank you, CII, for this fantastic topic, interesting topic. Before I start my discussion with my esteemed panelists, would be good to have a quick round of introduction from my panelists. So a quick 30 seconds, starting Harsh with you.
Sorry, can you guys hear me? Sorry.
Yeah, we can hear you.
Yeah. Hi, guys. Thanks, CII, for inviting me on this platform. And thanks, Vinay. Guys, I run Lending Card. I'm founder and CEO of Lending Card. We are a SME lending platform in the country. Overall, our core focus is in the range of 50,000 to 10 lakh rupee loans for micro and small businesses. We've created end-to-end fully digital process for serving them. We've disbursed almost 10,000 crores plus till now in 4,000 plus towns and cities, and we've never ever seen 99.9% of our customers ever. The money goes online and comes back online as well. Yeah.
Fantastic. Nagin, do you want to go next?
Sure. Hi. Thanks, CI, for inviting me. This is Nagin. I am the CEO and founder of Digitab.ai. So Digitab was formed in 2019, and for the last 3 years, we have been providing a lot of API and SaaS-based solutions to fintechs, banks, and BFCs in the areas of both digital customer onboarding and as well as credit underwriting. So yeah, that's pretty much on from our side.
Thanks, Nagin. Sarabjit, go to you.
Sure. Thanks, Vinay. Hi, everyone. Indeed, thanks for CII
for the setup. So quickly about us, I'm the co-founder and managing director at Finvasia. We predominantly diversified in India in the capital market space through our product Shunya, and we have an NBFC working on building up a neobank in India. Globally, we're also diversified and active in the investment banking space through regulated under CISEC and Mauritius and UK. And recently, we also diversified in healthcare. So as an engineer, we're trying to find out where all the technology can put in. And in India, it's more on the fintech space, building products in-house and working on that area. And happy to meet everyone on the dais today.
Thanks, Sarabjit. Gaurav, over to you. Quick one, yeah.
Hi, this is Gaurav. I represent Paisabazaar. We are India's largest marketplace for loans and credit cards. Paisabazaar is now about 8 years, 8.5 years in operations. We are a platform, as I said, for loans and credit cards marketplace for consumers. We also run India's largest credit score initiative, awareness initiative, where we have about 30 million consumers who have taken credit score from us. Personally, I've been in the company for about 8.5 years since the company started. About 14 years of experience across insurance and lending.
Fantastic. So we'll also have Mr. Soni joining shortly, but just without much delay, quickly starting on our panel discussion, and thank you all for joining this discussion. We have an interesting representation. So we have representation from NBFC side, we have representation from bank side, we also have representation from fintech side, and through Gaurav, we have representation from marketplace side. So interesting representation to cover all our points today. So the topic today is on the fintech era, which is driving culture, strategy, and innovation. Now, essentially, over next 1 hour, what we're going to try to decipher and discuss is banks, NBFCs, and fintechs have been partnering with each other in last few years. How this partnership has really transformed from a financial services product perspective across the value chain, be it from a product differentiation, acquisition, fulfillment, monitoring, or collections. So that's going to be one key component for discussion today. Second is on how fintechs have enabled banks or NBFCs to bridge the gap. Essentially, in terms of given the innovation which fintechs have brought in the market, how banks and NBFCs have looked internally within the organization and made changes to have differentiated products, reduce the time to market for various products. So that's going to be a second component. And the third, which is very interesting, which we're going to touch upon today's discussion, is on 2 years back, RBI came with a guideline on co-lending. We estimate the co-lending market by FY27 to be somewhere around close to 5 lakh crores. So how the co-lending market has evolved till now? What are the challenges in co-lending, and how do you see co-lending taking off from at scale going forward? So some of these aspects we're going to touch upon as we go through our discussion. So starting with Harsh, with you, you represent an NBFC. India has seen significant digital ecosystem, digital infrastructure being developed in last few years, and it has enabled us significantly. According to you, in your view, what are those top three digital infrastructure which has been brought in, which has transformed the financial services products?
I think, see, at the overall public stack side, right, we have account aggregator, we have India Stack working fundamentally very well. We have GST and others also getting automated, right? The data is now easily accessible overall. And within India Stack also, we have KYC, eKYC, sign-in as that's picking up overall, right? I think that's on the public stack side, like UPI is happening, right? A lot of transaction data is happening. We have internet companies now also willing to share their data, right, as an alternate data. So those things are obviously moving. I'd like to share, Vinay, from the consumer perspective, right? In this decade, basically what we are realizing is all of us need to solve for three things for them. The first thing is, Vinay, we all need to be cloud and digital native overall, right? Because in future, the fight for customer is now moving from number of branches you have or number of basically people on ground to basically it's moving to what is the UI UX? Can you digitally connect with him, right? Is he able to access you easily, reach out to you easily, communicate to you easily? That's one thing. Second, the transition and important piece that we are looking at and we've realized is again personalization of service, right? Overall, data that has not happened. We all need to focus on that as well, right? I think like we had seen for shampoo sachet changing the FMCG industry, that kind of miniaturization has still not happened in financial services, right? Miniaturization on micro miniaturization of products, right? Where it could be basically customized to the needs of products, right? Can he pay insurance premium not upfront, or can we give him bite-sized products as well to serve his daily needs, right? So that he starts to make credit some part of his daily journey as well. And third, the transition that we are seeing is, I think we all stay in an instant gratitude ecosystem right now, where if we don't get our food in an hour, we are unhappy. If we don't get our e-commerce deliveries in a day, we are not happy, right? I think we in financial services will have to understand this change as well, right? And so I think my personal realization is that experience and engagement of the customer will have to be focused as well for future overall. And that has still not been the hallmark of financial services, where it was always pull product, right? The customer needs a loan, he'll come to you, he'll give you whatever you want, he'll bear all the mental and physical and health costs around it, but he'll still take the money from you. I think that will change, right? Because the ecosystem is changing. So these are the things, Vinay, I feel personally that these are the changes that are happening in fintech ecosystem and overall. And I think that's where I think, like you suggested, co-lending is picking up, right? Because this collaboration solves, on one hand, it's all for depositors of money. On the other hand, it's also for experience engagement with the customer.
Yeah, no, fantastic. I think rightly put. I think key point you have to take away from your points, Harsh, is instant gratification at the right experience. I think financial services we are not used to it. I think we as consumers are used to it in other products when you consume other products.
Instant gratification, when I just to add, is one attribute, right?
Yeah.
All of us have never focused on the consumer before. I think time is now to start focusing on the consumer and designing and doing things for his need. We've all been working within our ecosystems and our own companies, but I think the focus now will have to shift to consumer or the borrower or the anything that we want to serve.
Exactly. So I think taking that point forward, Sarabjit, we have seen, I'll come over to you in terms of partnership, right? Taking the partnership point forward. Partnership with fintechs have been in many shapes and forms, right? With banks or NBFCs, be it on the secured or unsecured lending side. What, in your view, what roles fintech can play in driving this partnership further with banks or NBFCs or fintech NBFCs?
Yeah, thanks, Vinay. So I think we've heard this for quite a while. Banks wants to be fintech, fintech wants to be bank. This is becoming a story. But I somehow still feel that banks still have some kind of I wouldn't call it as a fear factor, but more on looking themselves as a competitive to the fintechs, whereas fintechs have always seen them as a complementing to creating their own ecosystem. So that particular gap itself explains that how this partnership model has to evolve. I mean, I understand that and Aadhaar and UPI and all those things are always helpful. But when it comes to financial inclusion, we need to understand that the only way that can happen is when the fintech is out there and making it accessible. And that typically comes, and part of it is obviously, the experience, the user journeys we are trying to create. And most likely because everyone wants to be on a mobile more than, even with anybody else in their own life. Looks like how we will create these ecosystems are going to be very interesting. And as I said, the whole innovation typically comes from the people who are more willing to take risk. And the legacy always holds back to an extent of doing certain things at times. But then, fintechs have always thought of, doing out of the box and then realizing, oh, I might be on the wrong side of the regulator. But that doesn't mean that, my intentions are wrong. So that partnership, I think, is surely going to be a learning curve. I still feel that we haven't come a long way in that kind of partnership, where the banks have kindly, I know there are APIs, there are, tech spaces which are giving opportunities to fintechs to scale up. But I still feel that there is a huge potential out there which have to be, probably talked out, create that comfort level, and then eventually you create your own niche, right? I mean, banks still going to be the custodian of the money. That will never happen because regulators want it that way. And fintechs will always come out with more ways to say that, hey, you know what? I understand your pain point. I will build a product around it. I will try to create a use case which will exactly fit into what you want, and then we'll make it work. So this whole journey, I think, is going to take some time for sure. We've come a long way. We've seen regulators pushing that co-lending space and, first loss FLDG kind of innovations coming into these spaces. But as at the end of the day, it's the client, right? I mean, if they want it certain way, the regulators, the industry will start thinking that from that perspective. So if you ask me, I think the model has come a long way. But since there are a lot of other opportunities, we're talking about account aggregator and other data points, which will really create this synergy on a more complementing manner rather than competing with each other. And I think banks have also come a long way. We've seen banks eventually now becoming more of a fintechs as well, by offering these products. But from a long-term perspective, yes, I think we still have to, take these. We are done with the baby steps. I think we need to start running together now.
Oh, got it. I think you rightly put in terms of fintechs. One, obviously, there will be multiple roles fintechs will play with banks. Some cases they will compete with banks. Some cases they'll collaborate with banks. I think just taking that collaboration role forward, and Gaurav, I'll come to you in terms of, so you have been working with banks and NBFC as part of your company, and both on the acquisition and fulfillment side now, right? And when it comes to fulfillment, right, the partnership becomes critical in terms of giving that experience which Harsh spoke about seamlessly on your platforms. And one critical pain point throughout the industry is on the entire, we say an STP or a purely digital kind of a journey. But the fact is there are drop-offs. There is no seamless STP. Indian consumers still need some level of assistance. So drop-off management is critical. And given your marketplace, how have you managed this through some of those analytical tools to drive the customer back to the platform?
Yeah, it's an interesting question. I think drop-off management. Yeah, it's a term we've used over the last few years. I think if we take a step back and see why do customers drop off, I think if you look at it from a consumer's perspective, if he doesn't get what he needs in the way that he needed, essentially that causes a drop off, right? And it is as much of a product, sometimes a gap, as much as it is a process gap. A lot has happened over the last few years on the process side as well. So, and look at it from a platform's perspective, like us, who only earn our bread when the consumer gets a product. We don't make any money before that. So for us, it's almost like a critical success factor, right, or existential concern. So we would like to look at it, and we look at it like almost preemptively, that how do you prevent drop-offs in the first place? And the way I see it there, if you can right size the product, you make the offer as much as accurate as possible. As a platform, you can construe it as right matching also. When you, and once you start creating programs, then it becomes more accurate offers. So that's the first part. And what we've done over the last 8 years is use a lot of data to create products or programs, and also ensure that the drop off is lesser, or consumer gets it in the manner that he is looking for. So one of the examples is that how do we use credit score information? So we have this credit score program where we have the credit score, a credit report, credit profile information. How can I use that to create the data to use or create programs where the consumer, where I can almost, if I can tell him that it is almost like a pre-qualified or a pre-approved loan, which at on the other side eases the process. So we're trying to fundamentally answer that question, that how can you make the offers more accurate? That's the first part. The second part is essentially in the right process. So pre-COVID, you would realize the lending process was as broken as it could have been. And COVID made us realize that the industry would stall because the processes were not in place. And of course, in the last 2 years, there has been a lot of thrust, and from all perspectives, and to laud all industry participants or ecosystem participants, as much as the regulator or the capability providers or the lenders, all of which are represented on this panel. So I think the process becomes the second most important, like in terms of how can you build end-to-end digital journeys? How can you get information from the customer in the easiest manner possible? So that is the second aspect. The third aspect is how can you use more and more intelligence that you have about the customer from him over the past that he's given you, or from other sources, of course with adequate consent and commissions. How can you use that to ease the journey? So these are the three things that we see that eases the customer aspect, which will prevent customer from dropping off. And if he does drop off, which is, how can you support him from all channels, whether it is tele, whether it is digital, all mediums, including WhatsApp, chat, and how do you put it all together to ensure you get him the product that he needed in the first place. That's, yeah.
Yeah, so I think good points there, Gaurav, in terms of how do you get the customer back through his preferred channel, ask more only that kind of information which is required for you. And the third aspect which you touched upon is the entire data aspect, especially on the underwriting side. And Nagin, this is a point I wanted to come to you on. See, data is becoming critical, and how you underwrite, use alternate sources to power the digital journeys, right? In your view, in your experience, what potentially could be those alternate data sources which would be helpful to have this digital customer journeys or seamless digital journeys without drop offs, which Gaurav spoke about?
Yeah, thanks, Vinay. As you rightly pointed out, data is nowadays becoming more and more important in terms of not just on the underwriting point of the journey, but also on the customer onboarding piece of the journey as well. Just to plug some of the gaps that that are emerging out of these drop-off areas and things like that, right? Especially coming to the underwriting point of view, right? So we at Digitap, we provide alternate data sources to a lot of these fintechs that we work with, right? And as you can rightly see that it is the fintechs that are predominantly being at the forefront of using alternate data sources for underwriting purposes, because they are the people who are actually going and serving the bottom pyramid of the customers, so the bottom rung of the customers, which are like the next 400 million sort of customers in India, and as well as the customers who are new to credit, right? And when customers are new to credit, you do not have any bureau score for them, you do not have any bureau representation. Managing their credit risk becomes that much more difficult, right? Which is where a lot of these fintechs are, and that's where they have some of these complementing services to the banks as well, right? Where banks are afraid of touching customers who do not have a bureau score at all. These fintechs have created a niche by using these alternate data sources to underwrite those customers in a way where I mean, I know some of the fintechs have fantastic repayment rates. Their NPAs are as low as in the lower single digits. But and they have been able to make that possible only by the use of these alternate data sources, right? And some of the data sources that they use are the bank statements, data from the device, data from e-commerce applications, data from telecom data of the customers, employment data of the customers, and some of the fintechs have gone ahead and used. They've created models around the social media presence of some of the customers and how that is tying up to their credit risk, right? And location as well, right? So based on the location of a person, like how affluent could the person be? So there are plenty of fintechs and there are plenty of startups like Digitap who are coming up and providing information on all these various data sources that I've just spoken about. Not just providing information on the data, but also developing scoring models that are relevant for the fintechs to be used, right? So that's where they are differentiating themselves as well, wherein they are building certain scoring models which are ready to use sort of scoring models, similar in the scale of what a bureau score could be, right? So that helps a lot of these fintechs in actually taking better decisioning on customers who have a less credit score for some reason or the other, but they want to improve their credit score, and also on the NTC customers, right? I mean, and NTC is a huge segment. If you see right today, 40% of people being served, 40 to 50% of the people being served by these fintechs, especially in the credit areas, are NTC customers. So the alternate data sources and the ability to underwrite customer using these scoring models that come up from these data sources is the key differentiating factor that these fintechs use.
Definitely, alternate data sources are going to be critical. It's just that in a lighter note, now we have to see going forward which of these alternate data sources, given the digital lending guidelines, could be leveraged. So that is going to be an interesting area to look forward to. But just getting a bank's perspective, Sony, just coming to you on to get the bank perspective. Banks have undergone, some banks, large banks have undergone, or some are in the process of undergoing the digital transformation in their own banks across retail, MSME, agri portfolios. How do you see banks leveraging fintechs, and which areas to drive the customer experience across the value chain, both acquisition, fulfillment, and monitoring?
Yeah, thanks. I mean, I'll start off by giving an example of what we have done. I mean, in the last 1 year, as a bank, we have been having a credit card portfolio through referrals. So basically, it was not adding up to a balance sheet, but we were using that as an opportunity to, kind of learn about the whole business and so on and so forth. So at some point, we were looking at partners and we were about to try and invest in, capital to create the infrastructure, then go and scout around creating channels for customer acquisition. And that's when we start, kind of hit upon the idea of tying up with a fintech. So this story, of last year's, I mean, within 3 months, net, we were able to actually roll out a very strong brand. It's actually one card, which incidentally has similar now tie-ups with others. But then we were one of the early players with whom we started. And the whole process, took us only around 2 to 3 months. The time to market was only 2 to 3 months, which in a traditional bank's, kind of model, it's very difficult to achieve because, you have to first go through the whole investment in infrastructure. You have to go through the process finalization. And until and unless you have a partner who is very agile, it becomes very difficult for the whole process to get completed. And as a result of this, the reason why I'm also citing this as an example is that on the ground, the numbers are very, very good. In a matter of a year, we have crossed 100,000 cards. And then we have also topped in various parameters in terms of highest card spending per month, the total number of spends in a year, volume-wise also. We are right at the top. And for a small player to start off, and these are parameters which doesn't have a base. So it's like we are competing against the biggies and still making it count. I think in that sense, it has been made possible only because this whole journey was completely end-to-end digital. I mean, in a matter of 7 to 8 minutes, you are getting a credit card with a virtual card without even a single paper being signed. You also then, of course, at a later date, get a metal card, which is the USP in terms of the physical form factor of the card. Now, these are the kind of markets that we are looking at. Now, in this case, it is not just the digital journey that we were able to, streamline with the help of the fintech. This particular fintech also has a partner through whom we are getting great NTB customers because there is a scoring app that is being used extensively by the customers who then become the bank's customers. And there, of course, subsequently, there is a lot of potential for cross-sell and even upsell also in certain cases. So I think this is the model that works very well. Now, there are other things also that probably has been a very good success story, but then those are all gradients of this in the sense there could be at the other end of the spectrum, a tech fin who is providing a great platform for digital acquisition, but then he himself is not able to bring in the customer. So the bank has to complement based on that. So I think between the spectrum is where all the banks are playing, where there is a fintech who is bringing technology plus market, and at the other end, there is a tech fin who is bringing great technology and the bank complements it with its own strengths. And in between, there are success stories. But let me be candid while admitting that there are also stories which has not been all that successful, which is the part of the game. But the only important thing that, of course, nowadays, in the last few days, as you were rightly mentioned, there's a lot of regulatory also scrutiny that is coming into most of these arrangements, which we believe is for the good, because at the end of the day, the customer is owned by the bank, and we wouldn't want any situation where they are put to a bad experience because of some wrong practices or processes that are being followed.
No, I think very rightly put, Sony. In terms of you actually summarize the roles. In one of the roles through this case study, you are partnering with the fintech for acquisition, reducing the time to market. But there are other roles which bank can partner with fintech on the technology fin side, right, or the platform side, which is more on driving the journeys than acquiring the customer. So the various roles which a fintech can play in. But just taking that credit card example forward, and Harsh, this is where traditionally fintech's digitization has solved the unsecured lending problem. Broadly, it is solved now in India. But when still comes to secured lending, and we spoke about earlier the digital infrastructure, we're still some way away because the digital ecosystem or infrastructure is still not in place, be it land record digitization. So, how do you see the secured lending panning out from a digitization perspective, and what role fintechs can play in this going forward?
I think Vinay, we are still not we are still in early days for unsecured lending as well. We are still developing and building it up. I think one of the critical pains over there was access to data. access to rightful data, like account aggregator or banking data is one, alternate data is another one, GST data is third, right? And I think a lot of us have been able to solve because that information asymmetry between the consumer and us was there, which is now getting solved. We get to understand him better and better. And all of us have been working on data-driven models, right? Whether it's machine learning or algorithms and everything, and solve for unsecured lending. And I think a lot of us have also have been focusing on cash flows rather than just the conventional metrics of income or balance sheet or P&L, right? So for unsecured lending, it's getting solved reasonably well. I think for secured lending, we will have to do similar stuff, Vinay, as well, right? I think if you look at the entire process of secured, right, it basically currently is dependent a lot more on recovery value of the asset, right, rather than focusing on the income and cash flows. So one way could be that we start identifying proper income and cash flow parameters and start focusing a lot more on them rather than just the recovery value of the asset or loan to value of the asset could be one. Secondly, I think like you suggested, it could be digitizing the entire ecosystem. If property records are digitized, right, finally, if they are easily accessible, right? So we are seeing a lot of changes in recovery as well, right, in enforceability. A lot of legal records have got everything. So that is all happening, but that's part of the ecosystem buildup, which will still take some time, 3 to 5 years. If we want to solve it before that, then we'll have to figure out some other way, right, of doing it and being able to enforce it as well. Otherwise, it will take the regular ecosystem time of everything, right? I think for payments as well, right? We are able to now give bite-sized loans because payments has got digitized to the largest extent, right? Similarly, if for secured, right, for property and everything, those kind of stuff can be secured, right? Overall, I think like for if we just don't look at property, if we look at gold, right? If there can be some form of certificates, right, tradable certificates, right, which can be shared. Similarly, if there are like for insurance policies as well, right, lien marking on insurance policy and those kind of things are sorted, right? Or if there are again tradable receipts for that as well, where you can trade some portion of your insurance premium already accrued to you, something like that. Those kind of mechanisms or platforms will have to be built, right, with with visibility to the entire ecosystem, right? So that the entire ecosystem accepts it. Like UPI is a payment system which all the banks accepted it. Similarly for gold, for insurance, and those kind of other assets as well, and property as well. If we can have similar kind of framework set where everybody is willing to accept that on trust that that can be enforceable in the law as well, and they'll be able to recover their money as well, which might solve it a lot better. I think maybe we are moving in that direction, but in a lot of developed economies, blockchain and other newer stuff, right, which is on anonymized data, and those kind of systems are solving for this. I think in India we need to start thinking about in those directions rather than just trying to solve it module wise, right? That if the land records get basically digitized, then only I'll be able to solve for secured. So maybe some newer way will have to come, and somebody will have to start thinking about that, Vinay.
No, interesting. And I think somewhere you mentioned around, if I had to draw an analogy, a dematerialized format of
Yes,
some of this
exactly. That's the
securities,
correct
a
word.
depository of the NSDL CDSLs of the property or a gold. Yeah. No, no, interesting point. It's just taking, and during this discussion, we spoke about, we touched upon account aggregator as a model, or OKIN as a model, right? It's
Yeah.
emerging now, it's gaining traction. Increasingly, some of these sites shows exponential consents going through. So Gaurav, just as a LSP, right? If I had to look from your perspective as a LSP, how have you leveraged the emerging frameworks, the data coming through account aggregator OKIN, to further simplify your offerings to banks and NBFCs?
Yeah, so just to almost take a step back and see what is account aggregator trying to do for the country. It is trying to get, as Harsh rightfully explained, trying to get banking, investment, taxation, and some other sources data into one place, which is the or account aggregator infrastructure. So, and if you see some of this and a lot of this information can and is getting used for underwriting today. It has the potential, and for the segments that it can be used is the whole marginal segments, right? The salaried, near prime, subprime segments, the micro and small enterprises which Hirsch organization caters to, and they've been marginalized from a lending perspective, right? Because the lenders have struggled for leave apart the last 2-3 years where all the innovation has happened, struggled to underwrite because either the cost of underwriting is too high, or getting the right data is very difficult, or accuracy of the data is very difficult, and the process is very painful, and hence those customers have remained out of the credit loop, right? So that is what A is trying to do. It's, in my mind, it's early days. It is still, it will become mainstream in a few years. And what we've seen with Aadhaar also, right? When the technology or when a concept becomes mainstream, a lot of use cases emerge automatically. You see Aadhaar today, it is being used as a payment system or an enabler for payment system, as well as authentication. Multiple use cases have emerged. So I think that's what will happen with account aggregator also. It's early days from an adoption, from a repository perspective. Having said that, I think once this happens, or while it has started to happen now, what will happen essentially is that all that data that is required is coming from one source, which is 100% accurate. It is easily accessible. The cost is extremely low. So for us to be able to help consumer becomes very easy. So because I can first get this information very easily, the lenders have to be able to accept it and waive off the requirement for a physical bank statement or any other data that is coming from one of these sources. So it will make consumers' life very easy. It will lead to expansion of credit, so which is a platform which helps me immensely, right? One of our objectives is, as an organization, is if 100 customers come in today looking for credit, how can I enable more and more consumers to some form of credit? And that's my job, to tell them which form of credit and from where, right? So that helps us from a consumer perspective. From a lender or a partner perspective, it does help them reduce paperwork, eliminate paperwork completely. We straight away enter the system. It's all automated, all algorithm based, reduces time for consumers to get a loan. So these are the ways I think it will help. It will just play out, and the responsibility of that playing out is on all the participants of the ecosystem, which is us as a platform, lenders on the other side, regulator, as well as the capability providers. Because the more you start to use it, and that is when the cycle of test and learn happens, right? The more you use it, the more you know how it works, where it doesn't work, and that is the responsibility of all of us to ensure that it becomes mainstream in some time.
Yeah, no, I think rightly put. See, it is going to lead to democratization of credit, right? Account aggregator, purely because finally customer owns his own data. But just taking that forward, accessibility of data is going to increase, and that will, as you rightly mentioned, Gaurav, throw up new use cases. Now, Sarabjit, through your companies, you presence in both NBFCs and broking. This is an interesting use case because account aggregator gives you an holistic view. Now, SEBI also coming through into the network, which is very welcoming. SEBI coming into an RBI network. How do you see the accessibility to data through account aggregator further being leveraged by fintech like yours across all your group businesses?
Yeah. So, Vinay, yeah, thanks. So again, I think part of what we have all agreed is that, data is surely going to help us, and it's just going to help us to make some decisions wiser than what we were initially taking. And that is what I think, most of us are working on. So naturally, the decision making starts as soon as you get a client on board. And, for us, when we're talking about, the neobank product we are working on, it's purely on a, B2C retail kind of focused area. So it is very important that as soon as you have someone who is looking forward to engage with you, you have enough data to drive certain decision makings for us. It could be on the investment side, it could be on the digital lending, it could be financial planning, anything. As a product, you need to first take some decision making for yourself, and then obviously, you build on top of it. And I keep saying that when you get a client on board, you build a product. But once you get the client on board, you get a data which helps you to then create further products, which helps you to give, a next level of service, which comes from what you see what they are doing. And that is where I think most of these data points, in the capital market, we have seen the KRAs and CKYCs, and all of them have been very helpful. We're talking about back in days, when this whole API was just a keyword. And, when we started discussing with SEBI and we're saying that, you have a KRA, start giving APIs of them. And Aadhaar had already given the API. So all we had to do is just put them together and saying, hey, your digital account opening is done. And nobody was kind of agreeing to it. And now we have seen how Aadhaar has come such a long way. And I still remember, back in days in the capital market, trust me, I mean, getting funds into your trading account was like, you probably have to run down to a bank, or you need to have a good friend in a bank who will just do these transactions for you. And then at the end of the day, you will just give them the checks or something. But guess what? I mean, we've seen the UPI coming up and everything is just, being like, are you serious? Do we still own checkbooks? I mean, that's the kind of life we are getting into. And I still feel that this whole account aggregator is still in the early stage. We probably can't even think of the use cases which will eventually come out of this whole particular product. And when these innovations are coming through regulators, then obviously there is a push from both sides, from the banks to be on the board and for the fintechs to say that how will you really help this to create a much wiser or much wider ecosystem. So these data points obviously help for any product, obviously, to get into the space where they say that how do I build a convenience for my client, right? At the end of the day, all we are looking forward is that I want to save time for someone to do thing which needs to be done and over in few minutes. I mean, I still remember when we work on a product, we work on a simple, ideology that every task should be done in 3 taps, right? So the minute you ask clients to use more taps, they just kind of lose what their interest is. How we initially started off, the leads being lost in the whole transaction, and that's where clients also lose interest on using the application. So it obviously has to be very convenient for them, and that can only possible if you have the data, how they're using or driving this mobile application. And I think more importantly for fintechs as well, I mean, it's not possible to scale up, right? I mean, at the end of the day, the business drives to be either organic or inorganic growth. And in both the cases, unless fintechs have access to the data which can really help them to make these kind of decision making, it's just not going to be any justice to it. So to answer to your thoughts, I think data has really been very helpful. At least the account onboarding, the acquisition, which was more like history, we have seen how we still had to sign 18 to 20 times on a bank account, and now we have like you're done, you don't even realize your bank account is open. So those things always help. Data always help both sides, the consumer and the fintech. I think what really boils down to is that how do we keep innovating around the data? And as I said, we all build products, and then data helps us to drive further level of service, which comes from these data points to help us know that what my next step or how do I really be more innovative in this fintech space.
No, right, and I think that is going to be key going forward. What use cases we are going to build on those? As you rightly mentioned, it's still early days, but Sony, just coming on that point itself, taking that point of account aggregator forward. 31st July, we saw large banks, which large liability bases going live as FIPs on account aggregators. Uh, the two use cases which has been widely discussed from bank perspective are on essentially on with respect to account aggregators are essentially on credit underwriting and credit monitoring piece from account aggregator perspective. How do you see banks leveraging account aggregators and further evolving their products and the customer journeys?
Thanks. I see. The if you really look at the kind of sources that the banks already had access to, be it the bureaus or non-traditional data sources, it was like there was no selectiveness about it. I mean, you get the complete profile of the customer based on what he has done. With the introduction of account aggregator, let's not forget that there is also a consent layer that is coming in, which is the first time in the industry. So till now, obviously, the customer didn't have a choice. I mean, the bureaus were pumping in the data, and the banks and the NBFCs actually were using it. But with the consent layer coming in, there could be, I mean, the way we see it is that there could be a lot of incentives for the good customers, the good as in the the typical ability to pay and intent to pay kind of thing, which becomes very important in credit underwriting. I think in that sense, the customers do get a chance to cherry pick and showcase what they have done elsewhere, which then, because it is after all transaction data based on which we can actually then take decisions. So in that sense, I think account aggregator would be a very strong medium. The fact that it is very interoperable is pretty similar to what happened in the UPI side.
Yeah.
UPI did get a big leg up after the demon, so there could be a similar catalyst or a tipping point that could probably be round the corner. And as you rightly mentioned, till now it was typically a chicken and egg story. I mean, unless enough number of stakeholders are there as a part of the ecosystem, it was not making sense for many players to just become FIPs, because unless there is an FIU at the, I mean, FIUs also is needed. So now most of the banks are either already there on the platform or in the process of getting onboarded, and I'm 100% sure that this will add a lot of value within the banking ecosystem. And as Sarjeet was mentioning, with all the others also coming in, the SEBIs coming in and the insurance IRDA actually giving a consent, I'm sure that the whole landscape of the financial behavior, the financial patterns, etc. of a customer would become easily accessible to the banks. And so we are building use cases on that lines. There is also a similar line on the PFM segment, on the personal financial management segment, which is also gaining traction, because till now it is all being done using maybe a little bit of surreptitious methods in terms of getting the passwords, OTP, and then collating the data. But now it becomes a very transparent mechanism by which I can actually, with the consent of the customer, aggregate all the data and then give value-added services, be it on credit lines or on other lines, investment lines, to the customer. So the road ahead looks attractive. Yes, some trigger points are needed, and I think what it has achieved is to provide a good railroad, be it token or account aggregator. And I think the railroads will get used, as we have seen in UPI.
Got it, got it. So I think account aggregator definitely is a key one to look forward to, and the use is coming out of it. But I think sitting on probably keeping account aggregator as a standalone may not fully useful, because they are data blind essentially. What is going to be critical is the entire TSP, analytical TSP layer sitting on account aggregator data, the data which is passed to account aggregators, and how TSP providers are going to give those analytics to banks or NBFCs to enable them to take those decisions and make sense of the data which is coming through. And this is when again I just want you to come in terms of TSP solutions, right? Because account aggregator will just take the data from FIP and give it to a TSP provider, which is empaneled by a bank or NBFC. What kind of differentiated analytics you foresee being driven on this kind of data, which is coming from multiple sources in end state, from GST, from tax department, from all the SEBI regulated entities, the RBI regulated entities. So your views on this?
Sure. As you rightly pointed out, right? I mean, if you look at just the ecosystem in terms of the FIPs, FIUs, and the account aggregator, right? So what is being getting currently derived out of the account aggregator ecosystem is just the raw data. So in case of a bank statement, it's just a digitized version of your bank statement that you would otherwise have gotten in a PDF format, right? When you have downloaded from your net banking or what you get on an email, right? Now, what use is that raw data of two banks or NBFCs? It's of not much use, right? I mean, because it's just a raw data, it's just a raw bank statement, right? So the key really is in terms of what analytics is being provided by the entities like TSPs. We are a TSP that provide a lot of analytics on top of the raw data that comes in on from the account aggregators, right? So the key differentiating factor is the analytics that you are able to run on top of the raw data that comes in from these pieces, and how are you able to stitch the use cases that these analytics provide, right? In terms of providing these use cases. Now, as you rightly pointed out, there has been a huge discussion that is happening around credit underwriting from using the data source or using the data that is coming from the account aggregator ecosystem, right? But we envisage that there are further use cases, especially with the ability to do the right analytics on the data that comes in. There are use cases in the areas of collections, for example, right, and continuous monitoring, as you rightly pointed out, right? How can we build early warning signals to NBFCs and banks in order to understand that this customer might probably default going forward because the data that is coming in from the account aggregator and from the financial institutions is not great, right? So building of these early warning signals and enabling collections abilities, data driven collections abilities becomes a key use case that could be used, and TSPs are also working in terms of doing analytics not just from an underwriting point of view but also exploring such use cases. Another use case that the TSPs are also looking at is cross-sell and upsell, right? Like Mr. Soni rightly pointed out, there are a lot of personal finance management use cases that can be built using the data coming in from account aggregators, right? Now, once you have a complete financial profile of the particular customer, right, then it becomes that much more easy for you to offer tailor-made, personalized solutions to the customer, and as well as do a lot of cross-selling and upselling to that particular customer, right? And these are the various use cases that we see having a lot of lift off, especially with the account aggregator booming. But that also requires enough data coming in from the account aggregator ecosystem. Rightly, if you currently see, it's only the bank statement that is being enabled, whereas there is a lot of leeway and a lot of room and a lot of room for the other financial instruments to be enabled in the account aggregator ecosystem. Like, we currently do not get any credit card information, we currently do not get any stock related information or loan related information as well, for that matter, right? But we rightly see the TSPs playing a huge role here, especially with their ability to identify the use cases that make more sense for the banks and NBFCs, and providing the right analytics to enable those use cases, like what we've just discussed in terms of either building early warning signals or building collections capabilities, or building cross-sell upsell capabilities and things like that. So it becomes very much important for that. But I still believe that, especially from a cross-sell upsell point of view, we are still some way out because of the limitation in terms of the data that is being made available today as we speak in the account aggregator ecosystem. But I'm fairly confident that we'll get there in 2 to 3 years time.
Got it. I think a fair bit of focus is going to be on this frameworks going forward and how they have been leveraged and what use cases coming out of that. Just shifting a bit of our discussion on one pertinent point, which is also related to partnership. More we say partnership lending, but in a very defined framework, which RBI came up with last 2 years, and in multiple options, option one, option two of co-lending. Now, and Harsh, just coming to you and getting the NBFC side, since we have representation both NBFC and bank, getting an NBFC side of view of co-lending. Because co-lending has been there for 2 years. The AUM right now, industry AUM would be close to around 10,000 crore purely on co-lending, not more than that. So while the challenges, operational challenges, collection, reconciliation have been solved, what do you see are the key challenges to grow or drive co-lending at scale? Given the changes which RBI also brought in on option two.
Yeah, fair point. I think when I want to start from the fact that all of us realize and feel that that's the future, right? Like I said, on one hand, somebody has depositors' money, and on the other hand, somebody has the skill set to connect and engage with them better, maybe give cloud and digital solutions, maybe give personalized services as well, right? So I think that's the future. I think post-COVID wave two, there has been a phenomenal push from regulator as well, and from all of us as well, realizing that if we all work together and collaborate, that can solve for it, right? But I think still what happens is, and if you look at retail as a business that we all want to grow, it has two segments, right? One is self-employed and another is the salaried employed, right? Salaried is comparatively far more sorted as well, right? Because you have a salary slip, you have an FOIR, his income and spends are kind of understandable and everything. When it comes to MSME, right, and I can tell it from my perspective, it is comparatively a bit more complex ecosystem. You need to understand his financial statements, cash flows. You need to understand his operating cycle, debtors period, creditors period, margins, everything, and then based on that, identify a working capital requirement, then go ahead and solve for it, right? And I think all of us have been doing that business to underserved and MSMEs directly, indirectly, but the ecosystems that we've built internally, all of us, right? Whether it's how do we originate those cases, how do we underwrite those cases, how do we disburse them, and post disbursement, how do we track them? These are quite different, right? Overall. So creating a standardized product among them, Vinay, is not gonna be easy. I think this is one of the critical problems. Like today, we almost disburse 350 crores a month, right? And out of that, 300 plus goes to our partner lenders, and which is like 16 partner lenders are already live with us and 7 are in pipeline, right? But when we go and integrate with them on API basis or work with them on either model 2 as well, right? These, even for simple things like checkpoints, like before sanction, what kind of data do you need? Before disbursal, what kind of data do you need? What kind of checks and requirements do you need? It's very, very varied, right? So somebody will have to pick up that cudgel of standardizing it, which we are kind of doing for MSME space, right? Almost all the 16 lenders, we've been able to standardize them to a common process, which satisfies their risk and compliance as well, which satisfies the requirements of regulator and everyone as well. And finally, we are able to deliver a seamless experience for the consumer. I think for consumer space as well, right? In self-employed, we are doing, for MSMEs, we are doing, but consumer also somebody will have to pick up and standardize this. I think standardizing the processes and operations, right, and the customer journey is one of the most important pieces when all of us will have to solve in co-lending.
Yeah, no, I rightly mentioned, and you touched upon the one critical point in co-lending, which we have seen, that aligning the product parameters and the underwriting parameters across partners,
Yeah.
especially in a product such as MSME, unsecured MSME, MSME lab, micro ticket lab, is going to be a key one, because there are no standard sources and the underwriting varies from a partner to partner.
Yeah.
Yeah. So on just that point, Sony, just bring the bank's view on co-lending, right? Because there's one side there is NBFC, one other side there's a bank. A bank follows a certain underwriting procedure for a standard sold when you lend to MSMEs. And when it comes to co-lending, obviously there's another institution which is coming into picture, which is going to originate for you and also keep some part of it on its books, 20% of on its books. So, from bank's perspective, what have you seen the challenges of co-lending, and do you see co-lending scaling up going forward from a partnership model with NBFCs or fintechs?
Yeah, I think I would pretty much agree in large to what Harsh was mentioning in terms of the major challenge being standardization. See, it's very easy to look at the complementary aspect. While a bank has ability to accept deposits, whereas an NBFC is in a better position to cater to the advanced requirements of a particular segment of the community. But the key area is on two grounds. One is on the customer profiling. That's something that that we find a lot of challenges on the ground. Whether the bank is really okay with the kind of standards that are being followed by while profiling the customers. And the second is when it comes to the underwriting part. There, the standardization issue starts with the policies. Are the policies aligned? Sometimes the banks have very stringent policies which they are not willing to dilute because of the risk factor and the issues associated with it. And then comes the process side. And finally, I would also like to add the dimension of the technical integration. At some stage, even if the policies are aligned and the processes are kind of agreed upon, then the integration part becomes a challenge. There, I think the success stories that we have seen is with the aggregators who have come in creating a common platform and plugging into those platforms and aligning your systems is actually opening up yourself to an ecosystem which you can actually leverage on well. We see that model going good in a big manner going forward. Both entities are regulated, so there is no real issue of regulator having a challenge. So there are certain industries like you talked about PL. Gold is another space where there is a lot of success stories that we can talk about. But then in the SME space, you're absolutely right. It's not a very, because SME never was a structured model. Internally, the banks are now relying on a lot of data models, which is not only on the quantitative data parameters. For example, in our bank, we have actually launched a data model which is based on a combination of 6 parameters, one of them being even qualitative assessment of what based on what a lot of interactions with the customer. Now, in that kind of integrated model, what is the confidence that you can have on a fintech following the same practice or a NBFC following the same practice on the ground would be a challenge. So I think SME probably, we need to really see how it is going to shape up. Whereas on the other segments, I think we will definitely be able to ramp up. Having said that, we are seeing a lot of good success stories in the market. We are ourselves evaluating the ability, and because it is a co-lending model, we not only need to evaluate the quality of the customer and the asset profile, we also need to evaluate and underwrite the NBFC also to a certain extent. What is their rating and so on and so forth. So in that sense, I think it will take a little bit more time to really ramp up.
Yeah, yeah, and I think what you mentioned was clear. One is looking at the assessment of an NBFC, because you're taking an exposure through the NBFC, and also end consumer, obviously, which will underwrite. But there's one, and Sarabjit, I'll come to you here. There's one model which banks are evolve kind of discussing. Obviously, the co-lending is 80/20 model, which the guidelines suggest. But what they're suggesting is taking co-lending a bit ahead into partnership lending, a 100-0 model. Whereas fintech will source for me, a fintech will do servicing on my behalf as a bank and also do collections on my behalf. Whereas the balance sheet will sit with me, obviously within the rings of the new digital lending guidelines. How do you see this being further adopted?
Yeah, Vinay. So again, if you ask me, we need to understand that who is innovating in the market. If the innovator is the regulators, then obviously it comes from a different mindset. When the innovation comes from fintech, and I typically call that word because we are middleware, right? I mean, our idea is that we need to create a value either between a client or a bank or between a client or a user, whatever it turns out to be. So it becomes very important, when we are talking about, these analytical tools. So simple example, right? So for anybody to onboard, in our case, for an example, we wanted to have a very seamless single onboarding process. And when we do that, I have four objectives in my mind. How do I take care of the primary four pillars of financial services sector, which is saving, spending, lending, and investment, right? So somehow if I can create a journey which helps me as a neobank, that I have enough data, which then I will have to analyze, how that will really help me. Either it could be on a partnership basis, because if the dependency is more on the fintech or the person who is probably creating a lot of data points, then obviously, it becomes more important for us to make sure that, we go through those checks and balances, because at the end of the day, it's like, you're an extended arms for the banks. And that becomes very important because the decision is being done predominantly at our level. And then obviously, based on all those parameters from different banks, we need to keep fine tuning our ways to make it work. No doubt, obviously, data is really is building it up, and more importantly, I think for fintechs, there are going to be 2-3 areas where we will surely look forward, and we personally are also working on it. Is first is more on the predictive and preventive kind of tools, right? Because at the end of the day, first, a lot of people don't have data, and a lot of people have data, but that they don't know how to use it. So we really need to create, some tools on those data points and see how can I really do some kind of, preventive or predictive kind of analysis, which will help some level of future planning, not only for the companies, but also for the clients. So all that put together, if you look at it, I think, the KRAs, CKYC, SIBILs, all of them are more of a data points for the middleware. And once we have access to it, I think it is important for us to build product on the product. That's where I started off. You create a front end, but that front end is more towards taker data points. What you build after that is what drives your service factor and your engagement with the clients to make sure that you create a disruption or a USP within the market. And that what I think is all these data points are going to help create an ecosystem for the fintechs, which as I started off, they are always complementing banks and not competing. How do we really leverage it is something where we will see once we have this data, and how do we create different use cases out of it.
No, I think very well said. So essentially, co-lending moves to partnership lending. Partnership lending, giving the right offers, having the right data points in place. And when it comes to offers and data points, Gaurav, I have to look at you because being a marketplace, having the right offers to your customers from various financial institutions is core to how you present those offers to customers across your partner institutions. How have you leveraged some of this aspect in terms of, because given the points which Mr. Soni, Harsh mentioned, that the product standardization is an issue, and more so on MSME side, and you will be configuring product features or product parameters of multiple financial institutions. How do you see this problem being solved, or an attempt to being made to solve this problem?
So yeah, it's a critical problem. I'll try and explain the criticality of it. In a monthly basis, we get about 15 lakh inquiries for credit products, and imagine that those inquiries come from 1,000+ cities and towns. They come from across professional segments, which is salaried, self-employed, business owners, and others. They come from across spectrum on the primeness chart as well, in terms of income profile, in terms of bureau profiles. So if you see the complexity of, or the diversity of the consumer demand is so wide, and on the other side, on the supply side, we work with 70 odd partnerships on the lending, on the lender side. So imagine trying to marry this 15 lakh inquiries to the 70 lenders, and even today we are not able to match everybody, which is a supply, or which is an expansion of supply problem. So and it's a core problem, right? The consumer, and if we ask the consumers and we speak to them, the biggest problem that they say, and whenever we speak to them, they say the biggest problem is ki, will I get a loan or not? The uncertainty issue is the biggest issue, more than the price, more than the lender, more than the time. So it is a critical success factor for us, and the way we've been able to solve, or trying to solve it, I would say, is how do we use more and more data, which is like we started credit score, our credit score initiative, for the need of that to be more intelligent to consumers, right? So today I use about 136 variables to create a self-learning model which matches the borrower to the right lender, or probable lender to the right borrower. We're able to get 20 to 25% lift in our matching approval rates because of that process, and it's a continuous process. Currently we use digital footprint as and credit score data, and of course use a regressive model based on the lending that has happened through the platform, about 30,000 crores that has happened through the platform. So marry it all together, it's a problem that's a solution in motion. How do we solve it in future? I think as more and more data comes in, let's say the account aggregator data or any other data that comes in, makes us more and more intelligent. And while we become more intelligent, we try and solve the fundamental problem of consumer, which is essentially that will I get a loan or not, and trying to match him to the right lender to avoid multiple applications, multiple bureau hits, impact on his bureau score, etc., and just ease the core consumer problem. The second problem on the co-lending side, which you mentioned, which is an expansion of supply problem for us. So all the innovation that has happened on the risk sharing side, while it will move to a lot of co-lending side, will lead to an expansion of supply for us, because that's what the risk sharing models do. It gets the best of two or three worlds together in effectively helping the consumer. And when it helps the consumer, platforms like us are likely to benefit, because it helps us expand our supply, get more consumers to get a loan.
No, got it. I think the point you mentioned around what the consumer wants to know, whether I'm going to get a loan or not, a very simple ask he has, and matching that across data points, across the volumes you suggested is a task in itself, right? So when we talk about having those tech capabilities, having those matching the offers of the consumers with the risk profile or the ask of the consumer is a ongoing exercise. And Nagin, just coming to you on this point, given your solution and the machine learning algorithms, how have you tried to attempted to solve some of these issues where we have a strong recommendation engine matching the customer's need, customer's risk profile with what the partner can potentially provide?
See, traditionally, if you see, right, like even before the advent of this digital era, we used to focus, whatever financial products that the consumers were getting, it used to take them days. Either it would be a individual retail loan or an MSME loan, days or weeks for them to get the loan or get credit, right? Now, traditionally, fintechs, through their tech capabilities, of late in the last 3 to 4 years, have focused on reducing this particular time in terms of their using their tech capabilities. How do I reduce this particular time to minutes, right? And now you see that there are fintechs out there in the market who are actually providing personal loans using tech capabilities, where they provide a loan in 15 minutes, 20 minutes, 30 minutes, and things like that. So that's where the most of the fintechs have been operating on in terms of reducing that particular time that is being taken in order to provide the credit, right? Now, coming in terms of the latest fintechs that are now coming up, their main focus is not just on reducing the time, but also developing algorithms and developing data and crunching data in order to understand what the customer wants, even before he says that I want this, right? And then providing that particular piece to that particular customer in the same amount of time, in minutes or even like seconds nowadays, right? So there are fintechs out there who are actually trying to say that I'll be providing home loans in 15 minutes. I want to provide personal loans in 3 minutes with just 3 taps of a button, right? Now it's the more and more reduction in the time that these fintechs are aiming to look at, the complexity is increased, and their tech capabilities need to be in such a manner that they are able to identify the data points, the data sources by the various data sources that the customer is themselves providing them, right? And then we have the ability to crunch these data sources and then understand what the customer wants, and then provide that particular piece to the customer. So that's where I think again, going back to the point of the partnerships between fintechs and banks, right? I think that is where fintechs are moving towards, in terms of reducing the time to market and the time taken to provide credits or provide financial instruments, and as well as what instrument is needed, right? So that's where fintechs have innovated quite a bit. And in terms of the partnerships between fintechs and banks, and that's where I think the banks can take a leaf out of the fintech book, saying that this is where the fintechs have worked well, and this is where as a complementary partnership, that's where I think the partnership model can bring in.
Got it, got it. I think interesting perspective, and again on the entire leveraging of analytical tools for mining the data, right, which we are getting. I know we just have last few minutes left, but I don't want to end the discussion before we discuss on one critical aspect. Till now, we have been discussing all about disbursements, all about the interesting part. Let me touch upon before we end one particular aspect. And Harsh, I'll look at you in this. When it comes to collections now, and while all the data, all the journeys have been focused on disbursement, but there is a data available to do proactive collections or proactive monitoring collections. Your views on how this can further be enhanced as collections become a costly affair through a standard physical feet on street model.
Yeah, definitely. I think we've talked about applying data on distribution and underwriting, right? But that's just the beginning, and applying data on distribution and underwriting has been a lot solved as well, right? Like Gaurav in Paisa Bazaar have solved, we are solving for MSMEs, right? In underwriting also, a lot of banks are building similar models in-house. They are working on it. I think we've been also working, Vinay, on data models led collections, right? Whether this guy is basically going to be automatically. So we, like when we have dues at our end as well, our system automatically tells us this is a self-cure client. You don't need to worry about it. This is a cycle. He is normally paid after 2 days. That's okay. You don't need to worry about it. There is a then it comes back. If somebody does beyond 7 days to 30 days, he still pays us back. We know that there is some cyclical payment going on and it still takes some time, right? But there are cases which our system itself tells that 30 days it will take, 60 days it will take, right? And it is all ecosystem driven as well, right? Till now what we are doing is we've been too much touch and feel, right, overall for collections as well. A lot of time we don't input micro and macro economic factors, right? Assume there's a flood going on in Tamil Nadu. The assumption is that you need to understand that in that month or in that week there will be delays in EMIs, right? But do we need to be worried about it? Maybe if there is a damage or anything, then you need to worry about it. But otherwise, you can give some time to the borrower to understand that, right? So all these macroeconomic factors and everything, we all do collect data of those things, but we have not been able to implement them in execution, right? And I think that's what is going to change as well, Vinay, so that as we become more and more data driven overall, right, on distribution, on underwriting as well, the similar data will get used and data models will get used, Vinay, on collections as well. Finally, I think one thing that we've all realized is that the bite-sized products, right, will have to be kind of security or collateral free as well, right? You cannot take for 5,000, 10,000 rupee loans or 15, 20,000 loans or micro insurance products. You cannot get them collateralized, right? Because and that's what the need of the hour is, to customize it to the needs of the people and when they want credit, how they want credit as well, right? Overall. So those kind of data models will yield best of the results when in those as well. So like I think for all our partners, 16 partners or 7 plus in pipeline, right? We've had like the largest partner has given us a commitment of 1,000 crore. One of the largest NBFCs, nationalized bank has given us a commitment of 750 crores. We currently have 4 large nationalized banks on our platform, right? They see all our models, trust our models in collections as well, and then we show the performance as well to them, Vinay. So I think data usage has just begun in the country. I think like we discussed, right? Account aggregator is a phenomenal thing. If you can know his balance in his account the day before the EMI, you can do everything, right? And if you can get access to that, and similarly, all of us, we've never had the habit of interacting, engaging, and communicating with the client on a regular basis, right? With account aggregator, I can understand his data, how his business is doing. I don't need to wait for a year, right, to re-evaluate the client. And if that all is going to be done by algorithms only, right, or NLP processes, then I or machines, right? Basically, machine learning things are going to do it. I can do it on a daily basis, hourly basis, or maybe every second as well. So this is where we are moving. So this is all going to come, Vinay, and we will soon see every institution implementing these or partnering with institutions who are already doing these.
No, I think fantastic. And the use case you touched upon rightly, account aggregators gives me the ability, a brilliant ability to get his income even after the loan is disbursed, to know his income
Yes.
after the loan is disbursed, which is a strong tool for both banks and NBFCs, both for salaried or self-employed, right? So that becomes a good starting point from a collections perspective. No, I think fantastic insights, very valuable insights. Just to summarize, we are completely out of time. So just to summarize some of the key aspects, I know it's a very interesting topic. We can go on and on, but given the time which is given by CII, just sticking to that. So four key points we discussed. One, we spoke about the entire focus on consumer and aligning instant gratification kind of ask from the consumer to financial service product delivery. Point number one. Point number two, we also discuss upon what various roles fintechs can play in partnering with banks and NBFCs. On one side, they can definitely collaborate and provide value to banks across acquisition, fulfillment. On second, there are some areas where banks and NBFCs will compete with fintech, and it's fine. Banks have been doing among themselves this for years, where they complement also and they compete also. So that's the second point. The third key point was we discussed on the co-lending model, and co-lending. One, co-lending as RBI defines it, but also taking forward to a partnership lending. So it can be 80-20, it can be 100-0, basis the collaboration you have with the respective financial institution. And lastly, we discussed about account aggregator, the use cases, especially the collection use cases Harshu spoke about at the end in terms of getting access to his income after loan is disbursed. It's going to be a powerful tool to define and the use cases across credit underwriting, credit monitoring. Mr. Soni spoke about entire model around PFM. Sarabjit touched upon PFM model across various regulators, so RBI, SEBI, so broking, capital markets, and banking getting all together, which is a great scenario. So those are the four key takeaways. So thank you so much for your time, and thank you all for giving time, and thank you CII for taking up this interesting topic. With this, we can end the panel discussion. Thank you so much.
Thank you,
Thank you,
guys.
Vinay, for the great moderation. Great catching up, and
Good night.
indeed, all of you guys as well. Great catching up. Thank you very much. Thanks,
Good night.
CII.
Thank you all.
Thank you.
Thanks. Bye.
दिल धीरे धीरे धड़के आज होने को है आगाज सफर पर चलने का बढ़ने का इतना है हौसला मिटना फासला मंजिल ने मिल ही जाना है ओ ख्वाबों से आगे जाना है हमसे तो उम्मीदें हैं हमसे तो दिलासा है हम पे है निगाहें भी हम पे भरोसा है हम में है हीरो हम में है हीरो हम में है हीरो हम में है हीरो दिल से कहो ये हम में है हीरो दिल के कहो ये हम में है हीरो हम में है हीरो
हर हिंदुस्तानी में एक हीरो है और आज इस देश की धड़कन का एक नया नाम है आपका हीरो होंडा। अब है हीरो मोटोकॉप।
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will perform, I will outrank, I will achieve, I will fly high. I am the I in SBI. I am the I in SBI.
I'm backed by the nation's trusted bank.
I am the I in SBI.
SBI, the banker to every Indian.